Warren Buffett mentioned this quite briefly. He said that sometimes when he deals with risk and probability, he takes the potential of gain times the probability of gain against the probability of loss times the amount of loss.
Yeah.
And so it's like this, right, in decision theory. So at this price, let's say you're applying the Pascal's wages. At this price, how much do I have to lose, or how much do I have to gain?
Correct.
So let's say the company surprises the market and say, oh, we did 50 million or 60 million profit this year.
Yeah.
Okay, how much do you have to gain? I think maybe another 20 cents from the price.
Yeah.
Not much, right?
Not much.
But let's say the company disappoints the market.
Yeah.
Oh, okay, then it's a different story. What do you have to lose?
Yeah.
Before we begin the podcast, have you gotten your free ebook? It's called the Build a Six-Figure Portfolio Guidebook. Now, inside it, we share with you the tips and tricks to bring your stock investing skills to the next level. The best part, it's only 10 pages long and it's totally free. Whether you're on Spotify or YouTube, the link to download is in the description, or you can go to www.firl.co/FREE or www.firl.co/free. Hello everyone, welcome back to the FIRL Podcast, best place for long-term stock investors. Now today, we have a good friend, right? Mr. Leon. He has a very interesting background. Actually, if I know what the background you're from, I would never imagine that you would become an investor. Right? You have quite an artistic family,
Yes,
and then you
yes.
have a very sporty background.
Yep.
Yeah.
So but somehow you are now managing capital as well, right? For friends and family. But before we go there, right, we always like to start off with before investing, what were you doing and what was it like?
Give us a rundown of a 15-year-old Leon.
Yeah. Okay, firstly, before we start, I want to thank you very much for you guys for having me on board. It's my first podcast and I'm very honored to be here. So thank you very much. So I would say that growing up, my family, especially my parents, growing up with artistic parents. My mom is a graphic designer, my dad's an architect. And so they are artists, different forms of artists in their own right.
Yeah.
And money and investment is not something that we usually talk about at home.
I see.
Yeah, let alone investments, right? Not let alone real estate, property, and yeah, stocks is just, you never hear about it. You just hear Warren Buffett once in a while on the TV and that's it, right? And so, but I did grow up reading the Bible. And so when you're young, you tend to just skip the Old Testament.
Oh,
right?
yes.
Yeah, except
yes.
Genesis.
Yes.
You read the story of Adam and Eve all the way to Jacob and Isaac, and then you kind of just stop there, and then you skip the whole part.
The book of Psalms, everything, you just skip
the
already.
fun part, they skip the fun part.
Yeah. And then you just go straight to Matthew, right?
Yes.
Because that's about Jesus. Everyone's reading about Jesus. So growing up, I, of course, you just generally just go through the first four Gospels of the New Testament. And Matthew in particular, because that's the first book in the New Testament. So I always remember this particular parable and always stuck to me. And so it's the parable of the talents. So for the benefit of the listener, the parable of the talents is basically a story about a master that goes on this journey. And before he goes on this journey, he entrusts his wealth to 3 of his servants, each according to his own ability. So the first servant is entrusted with 5 talents. The second servant is entrusted with 2 talents, and the servant only 1, according to his ability. And so for just some context, a talent is not actual ability. A talent actually is about 32 kilograms of silver. And those days, it takes about 6,000 denaries to actually be able to buy one talent, right? And 1 denarius is basically 1 day's worth of wages.
Wow.
So in order to own that much wealth, even just one talent takes about, I think the math works out to about 18 to 20 years of work.
One talent.
Yeah, assuming that you don't work on the Sabbath, you don't work on Sundays, right?
Wow.
So 18 to 20 years just to earn one talent. So imagine 5 talents is your whole life.
Five lifetime. No,
One whole lifetime.
lifetime.
based on
Denarii is the currency for the Romans, right?
Yeah. In the Roman
currency,
Empire during
correct.
that time. Yeah. And so he entrusts 5, 2, and 1. And so interesting enough, depending on the translation, both of the first 2 servants invested their talents, actually got 100% back. So the first one got 5 back. So altogether 10 talents. The second one 2 back, and altogether 4. But interestingly, the last one decided to bury his master's talents into the ground, right? So when the master came back, the master says, good and faithful servant to the first 2 ones, you have done very well, and come and join and share in your master's happiness, right? But to the third one, he didn't get the same treatment, right? So the third one, he told the servant, you wicked. You wicked and lazy servant, right? You could have at least put my money into the bank and for me to gain interest on it, right? So that's very interesting, right? And so after that, he banishes the third servant that did not make anything out of his talent, and so it always stuck in my mind because this is about investing.
Yes,
it's not really about. Depending on the interpretation, but to me, the interpretation is just purely about managing one's money, managing one's capital, right? And so what's interesting about this is that at the end of the parable, it says that to whoever who has, even more will be given to them, and he will have abundance. And to everyone, to those who has, even more will be taken away from them. Interesting. To everyone who does not have, even what they have, it will be taken away from them. And so at the end of the parable, the master takes the 1 talent and gives it to the first guy, then manages to double the 5 talents. So then, but this part, I didn't really know the meaning behind it until I started investing and I learned about compound interest and how money worked. And then I realized, to everyone who has, even more will be given to them. For everyone who does not have, even more will be taken away. That's compound interest.
that's right.
Then
And inflation.
and inflation, right? And so I was like, then when you go back to it and you read it again, it's like, wait, the Bible is talking about compound interest.
Oh, yes.
And compound interest, in order to successfully manage your money and your wealth, you got to understand compound interest.
Yes.
Because if you don't, the likelihood of you losing your wealth is high. Because of the fact that you don't understand how compound interest works.
Yeah.
Right. So that was kind of how how it planted a seed in my mind. And then I remember when the first time I got my first salary, straight away I started saving up to buy my first stock.
Got to make the master happy, man.
Yeah, exactly.
But why stock? Why not property or whatsoever? That it's a very typical Asian thing. Why stock of all things?
Yeah. Okay. So that's also an interesting story. I think. During that time as well, I was also reading Rich Dad, Poor Dad by Robert Kiyosaki. And Robert Kiyosaki, I believe at that time, he was like the pioneer for saying that, real estate is not necessarily an asset. Okay. And so, but the thing about stocks is that, this is also related to my background, my educational background, because so I was very privileged to go to England to do my A-levels.
I see.
So I managed to secure a scholarship to study in sort of a private college in the UK. And over there, I managed to study philosophy.
I see.
And after that, for my degree, I did philosophy, politics, and economics.
PPE.
Yeah, PPE. I did PPE. And so equities, from the get-go, I knew it was an intellectual challenge. And it really appealed to me. And so the theological part was the one that first planted the seed. But because of my interest in philosophy, that it really, as I was looking into investing and studying how investing works, how to analyze companies. Then I started to see some of the parallels with philosophy and investing.
Wow.
So I thought that was pretty interesting. And I think for me, I'm personally, I wouldn't go as far to say I'm an intellectual, but to engage in intellectual inquiry, right? I think that it really appeals to me, and so so that's how I got into equities, and also at the same time I saw some parallels there. So one as I was studying philosophy, we learned this principle called Occam's razor.
Ah, yes.
Okay, Occam's razor, and it's applied. You can apply it to business, apply it to marketing, apply it to even investing, as I discovered.
Yeah.
And so, what Occam's razor states is that, or if all things being equal, the simplest solution is often the best one.
Yes.
So then, the William of Occam, who invented his Occam's razor, he elaborates that in order to explain anything, you do not necessarily have to increase the amount of entities beyond reason in order to explain it, right? And so what he means is that when you have to explain something, you always have to deal with variables and you have to deal with factors. But when it comes to complicated things, or even just anything as well, it's actually even better if you keep removing the extraneous variables and then you make it simpler and simpler.
Yes.
So for me, in investing, that was interesting because then it actually breaks it down, right?
Yeah.
Because when you look into a company, you are faced with
all sorts of variables.
Yeah, a sea of information.
Yes.
Where do you start?
Yeah.
Right? Like for example, what does this company do? Where is it in the value chain?
Yes.
The financial part? What is
Yes.
the management part? How is it valued in the market, etc., etc., etc. So it really helps to have that foundation of having, or how to it's not even there to even give you that frame of reference, but showing you how to shape your frame of reference, so to speak.
Actually, it's so interesting you mentioned that because on the way here, I was listening to podcast of Gary Tan, who is one of the early backers of Coinbase. And he was actually a partner at Y Combinator. And what he said, right, for Y Combinator to sieve through so much pitching, they narrow it down to 10 minutes.
Right.
So what he said is very simple. It's very, very related to your point, is that every time someone like Shark Tank, right? You have a very short pitch and then you have to pitch your idea very eloquently and concisely. He said a lot of the founders who try to pitch to Y Combinator and don't get the funding, he says, "Oh, if only I had more time." He said, "No. If you can't pitch your idea in 10 minutes, you've lost the game."
Exactly.
Yeah. It shouldn't be that complicated.
Exactly.
To sell your idea.
Exactly. And Gary was, I salute him because he was very upfront. He was saying that when he first started going into this game, he was worried that it would be too complicated for him to understand as that one. But his mentor, Paul Graham, right, was telling him no. And he gave a very insightful example, which was Theranos. Because Theranos made it so complicated, and we obviously know what happened to the Theranos saga, made it so complicated that they couldn't understand it. And he gave the analogy is this: it's like a gift wrapped in gold paper. Most people focus on the gold paper, but not the gift inside.
The essence.
The essence of it.
The essence, the core of it.
Yeah, the core of it. And you should not need more than 10 minutes to describe Occam's razor.
Actually, just to add to your point, right? This is something I just realized also. So you know what we do, both of us do, right? Like if I ask like a doctor what they do, you just say a doctor, people kind of get it.
Yeah.
But do you realize for us, when people ask us what we do, right? It's like, where do I start? so I don't know what's yours, but my Occam razor response is I just talk about stocks and crypto on YouTube.
You know what I do? I go even simpler, you know. I look at a guy, depending on my judgment call of who the guy is, I just say I'm a YouTuber.
Oh, right.
I just stop there.
That works as well.
Yeah.
So I mean, it's a great. I remember the description that I was given when I was learning about Occam's razor was don't multiply your factors beyond necessity. Something along that.
Beyond necessity. That's the word.
Right.
Yeah.
So that's a great segue into. So now you know the Bible tells you that please invest, right? Like God is telling you, please invest. So you can't disagree, right?
Yeah.
So I think sometimes for those who I mean, regardless if you're a Christian or not, there's some people who have this assumption that God is not interested in money, I think that's not true.
You know, even in Islam, they teach you that entrepreneurship is actually more valuable than just living life it is. I mean, I'm paraphrasing here.
Yeah.
But they said that the entrepreneur is actually very well regarded in the religion as well.
Yeah, actually, even in investing as well, if you look at Sharia compliant Sharia compliant companies,
Yes.
they're meant to reduce your risk.
Yes, exactly.
Right. They're not there just because they're trying to impose some kind of religious law.
Correct.
You know, but I mean, of course, this touches a little bit on so-called faith-based investing, right?
Correct.
But I do think that, you know, that having that sort of a list of Sharia compliant clients actually reduces the amount of risk that investors are willing to take, because, you know, there are a lot of people who still don't know yet how to analyze companies. And so if you just look at the Sharia compliant companies, then you know that these companies have low gearing ratio.
Correct.
Yeah, and then they don't engage in industries, gaming, alcohol, tobacco, and stuff like that harms people, so to speak, right?
Which is quite, I don't know whether you can call it more ESG.
Yes, it's ESG.
So it's almost way ahead of the curve, actually.
Actually, it's true, because actually there's a certain movement in the US. They call it faith-based investing, which is similar to like Sharia style of investing, where where some of the things that they look at is human well-being is one of the things that are prioritized, right? So like for example, the companies that the industries that these companies are engaged in, they can't exceed a certain amount of revenue from alcohol, gaming, tobacco, things that actually harm human health. Right. And of course, gearing ratio is one of the things. And I also I believe that a significant component of faith-based investing as well is that that there's a certain percentage where the company shouldn't be making from interest.
Interest,
right?
Riba,
So like financial companies and all that.
Yes.
Yes, so that's more to do with biblical principles, I suppose. But ESG is actually very similar, I would say, to faith-based investing. So I think that's very interesting, because then now there's a more emphasis on the sanctity of life, human well-being. And the environment as well. Of course, the environment part, you can argue if it's really biblical or not. But the parallels between ESG and so-called religious-based investing I think is very interesting.
Wow.
And I think of course in the short term it's not good for investors.
Yes.
But I think in the long term it's good. I think
it's good for many
the
people,
word is sustainable, right?
I think that's the key word. You nailed it.
That's right.
And sustainability over the long term is more important than gains over the short term.
Correct.
Especially when you're an investor that you're investing in the long term, and you want your companies to be engaging in sustainable measures. And I know it's such a cliche thing to say these days, sustainability, sustainable growth.
It's a buzzword. It's a buzzword.
It's also like, it's always subject to the specific company or the specific industry. Like what is sustainable? Let's say for a company in Perak, it's not going to be the same for let's say KL. But now so if I look at your journey, right? So I think it was the faith that kind of got you interested in investing, and then it was your when you were studying your degree, that's when it drew you to stocks, right? So how do you over time develop the way you look at investing? Like, what's your style, I guess?
Okay, what's my style? Okay, this is interesting. Actually, as a philosopher, we always have to first define the premise, right? What is value?
What's your hypothesis first?
So like for the first thing is like, okay, let's say I'm a value investor. Then the following question would be, what is value? How do you define value, right? So now there's this thing going on right now, like, oh, I'm a value investor, I'm a growth investor. Okay, let's say you take the technical analyst aside, then you have momentum investing, growth investing, value investing. So what does it mean, right? So I think for me, I define value as a significant margin between the company, my estimation of the company's intrinsic value versus the stock price currently in question. So I do think that is more of the accurate and more relevant definition of value these days. Of course, maybe during those days in the early Buffett or Graham time, value means low PE, companies trading close in net tangible assets or below the net tangible assets, and with reasonable earnings power, with the inversion of the E over P.
Yeah.
Yeah. So I think now what's more relevant, especially in Bursa now, is net profit, right? And so what is your estimation of the company's net profit? And even then, it's not so clear, right? So it could be 1 year, 2 years, 5 years, 10 years. So what is your estimation of the company's intrinsic value? And also depending on the time interval as well.
Correct. And also sometimes the PE compression and PE expansion. So
whether or not the E is
right. So I would suppose that I apply Occam's razor to my style of valuation because now I'm saying that value is basically like I'm able to value this company if I were to buy it or were to invest into it, I'm able to value this company significantly higher than its current stock price, right? So in order to do that, there are two significant components: your estimation of the company's net profit in the future, depending on what time interval, and the PE that you want to assume,
correct.
The PE growth that you want to use. Okay, this is so why I don't use discount cash flow is because I think especially I can't quite say if it's more relevant in Bursa, the PE style of valuation than it is in other forms of markets. I don't think that is particularly clear, right?
Yeah.
But of course, depending on analysts, you have different ways of valuing the company.
I think different business natures as well.
Exactly, right? So a lot of the small cap companies or so-called growth companies, for example, they don't have free cash flow.
Yeah.
Right? So discount cash flow becomes a bit more difficult for you to use.
Yeah.
And so also an application of Occam's razor, because discount cash flow has so many variables here.
Correct.
Beta,
it's the opposite of Occam's razor.
Yeah, it's the opposite. You have ERP premium.
Yeah.
Right? And cash flow. And then you have to decide the risk-free rate as well. Right?
Depending
on which
terminal
country.
value again.
And the terminal value, right?
Yeah.
So there's so many. And then each component has its own way of calculating it. So it's fun, like a little bit of spice and everything nice, blah, blah, blah.
Spreadsheet engineers.
But I think, with more variables, I think it just becomes very complicated. And even depending if you're a Buffett follower, then you don't use beta. I believe Buffett doesn't use beta as calculations. But if you're more like following Damodaran, Aswath Damodaran style, then you will have to use beta and correct it. But where do you get your beta?
Yeah.
Right? It's like, is it from like Yahoo Finance or your own version? So I decided, I think discount cash flow is fun, but I think it's better to stay away from it. So I use the PE style, right? And so I would say that yes, I'm a value investor insofar as that I'm able to use this method of valuation, and if I were to decide to go into a company, then I'll be able to find a significant difference. So margin of safety, if you will, between after using PE and the company's net profit in the future, and then finding.
It sounds to me that it's like an interesting mix of traditionally or what is commonly understood to be value and growth, right?
Yes.
Where does growth fit into your thinking?
Growth. Okay, I think I would say that, so for growth, I would say that companies who are defined as growth companies are the ones that have net profits increasing every year, and the share price have also reflected their performance, reflected that, right? And yes, it's also about momentum as well. And so let's take for example SuperConnet.
Yeah.
Okay. So SuperConnet, MJ and I, we attended the briefing.
Yep.
And at that time, I was in talks with some investors because SuperConnet is a growth company.
Yeah.
Right. It's trading at a P above 50. I think right now it's lower than 50 now. It's about 40 something, right? But at that time, the price was about 1 ringgit 80 cents, right? And so yes, it's a growth company, and yes, that the company is expected to make a profit. I think at that time, analysts were forecasting a profit of about 40 million for FY 2022. Okay. So I did. This is of course that I've also studied the company before, and And then I found out that, okay, assuming that its 5-year mean is about P of 30, and let's assume that the company is successful in reporting a profit of 40 million. Then you will realize that its market cap at 1,200, 1 billion, 1.2 billion, is already priced in at the price of 1 ringgit 80 cents. I think even at 1 ringgit 60 cents and to 1 ringgit 80 cents, 1 ringgit 80 cents is already way past that profit already.
Correct.
So this is a growth company, and yes, most likely it will continue growing. But at this price, is it cheap or not?
Is it baked in already?
It's baked in already. It's priced in. So to me, it was priced in. And so even though this company is great, it's one of its kind in Bursa. It's got all these things going on where its management is there's a superb management. And the company's run very well. It's got a great outlook. But yet, the price is not cheap.
So where's your margin of safety, you see?
Yeah, exactly. Where's the margin, right? So let's say, maybe I can buy at 1 ringgit 60 cents. But okay, so this is where like the other part of philosophy comes into play. Okay, this is about probability, right?
Yes.
And so I remember when I read The Intelligent Investor, Jason Zweig did a very fantastic commentary. It was beautiful, actually. Because of Jason Zweig's commentary, The Intelligent Investor was such a beautiful book to read.
Exactly.
Right, you got Graham's style of writing, and then you have Jason
the 1930s English, my
God. So I have to thank Jason Zweig for that. So he quotes Peter Bernstein, and so I think he's a kind of like an investor philosopher. So I know he wrote a book called Against the Gods, right? But I've not read the book
risk,
yet.
Right? Something
about
risk
against the gods. So I thought it was pretty interesting. But he quotes Peter Bernstein, and Peter Bernstein quotes Blaise Pascal. So Blaise Pascal was a physicist, and he was a theologian as well, I believe. And so there's this thing called Pascal's wager, right? So that's what I like about the parallels between philosophy and investing, right? So in Pascal's wager, basically in life one has to assume either God exists or don't, right? So let's say you assume God doesn't exist, right? You're able to go in life, just doing whatever you want, like you just succumb to desires, you just do whatever you want, enjoy yourself, right? But what are you wagering? You're wagering your soul, right? And then what do you have to lose? Let's say if you're wrong, God exists. God does not exist, and you're wrong. Then your loss is infinite. Okay, so that's terrible, right? But let's say you assume God exists. You assume, right? Let's say you objectively. Okay, let's put that aside. But let's say you just assume God exists and you go about your life
as if he's watching.
As if he's watching, behaving in such a way that you at least follow some of the
basic
principles, the basic tenets, the basic principles, in whatever religion that you follow. And what do you have to gain and what do you have to lose, right? What you lost, even after you die, I'm sure you probably won't be thinking, oh, I know I should have done this. Maybe yes, maybe, but then let's say you assume God exists. What if you're wrong? God doesn't exist. After dying, you don't lose anything, right? Right.
Become dust.
You just become dust. You don't think, oh, I should have done this, right? Because if God doesn't exist, then you don't even think anymore, right? You're just not.
Correct.
Right. But let's say if you're right, the gain is infinite.
Correct.
Right. So there's this, and so he's kind of like the pioneer in decision theory and probability, right? So Warren Buffett mentioned this quite briefly. He said that sometimes when he deals with risk and probability, he takes the potential of gain times the probability of gain against the probability of loss times the amount of loss. And so it's like this, right, in decision theory. So at this price, let's say you're applying the Pascal's wages. At this price, how much do I have to lose, or how much do I have to gain?
Correct.
So let's say the company surprises the market and say, oh, we did 50 million or 60 million profit this year. Okay, how much do you have to gain? I think maybe another 20 cents from the price. Not much, right?
Not much.
But let's say the company disappoints the market. Oh, okay, then it's a different story. What do you have to lose?
Actually, it sounds, in a way, if I could draw parallels, it's kind of like the Kelly's criterion in a way, but in a way, Kelly criterion simplifies whatever the probabilities that you mentioned and the odds are. And it's interesting that you mentioned, and I want to follow up with a question of this. When you look at all these probabilities and discipline and all that kind of thing, right? I want to draw probably parallels to your sporting life. Because because you see, whenever you take the shot, right? I mean, we both play badminton.
So for some context, we have
national player.
we have someone who spars with Tan Boon Hyung.
Yeah.
Sometimes.
And wins.
Yeah.
So,
Yeah. So when you take that shot, right, either a line shot or body shot, whatever, it's a calculated risk.
Yeah, exactly. Yeah.
Right? Because if you're going against Tan Boon Hyung when he's smashing that shuttle at 400
I'm
kilometers
going to link
an
this
hour.
to him later when the podcast comes out.
Right.
but apparently it doesn't smash nowadays. Now it's a bit. It's fine. I got the world record. I don't need
I
to-
think it's also partly due to injury as well.
Yeah. But I guess you know where I'm going from with this. Whenever you take that shot, that particular shot, are you knowing that the opponent, let's say, is equally skilled, even better than you?
Yeah.
When you take that net shot or a drop shot, right, you better make sure it's tight because if it's not tight, then you know he's gonna either tap you back or whatever, right?
Exactly.
But then before you can even get there, it's a muscle memory building through training and all that. And I want to draw that parallels to investing because what you've just mentioned or what the three of us just discussed was some kind of a muscle memory that's built over a methodology. So maybe first question is, how do you draw parallels to sports and investing? That's one.
Okay.
And you being a philosopher, I'm pretty sure you've got a lot to say. Second thing is that, is it something right for everyone, and how do you keep at that game in a sense that how do you overcome disappointments? Because I'm pretty sure there are times when your game was so bad and then you look at in parallels, your investing was so bad. Yeah, I hope I'm not, putting you.
No, I'm trying to remember the questions.
Yeah. First question is maybe
what are the parallels between sports and
sports and especially
investing?
probabilities and muscle memory.
Right.
And then second thing is whether it is something that everyone can take. Everyone can actually stomach in a sense of building that muscle memory. Is that something for everyone from your perspective?
Sorry, sports?
Yeah, sports or investing. Because
Right.
I see parallel. I mean, I don't know whether
Yeah. Okay, so for those badminton fans out there listening to this podcast, I think for those who've seen world-class badminton for quite some time, know that that among the top there are the Malaysian national players. Let's say doubles, okay, because we both play men's doubles.
Yes.
So and most people play men's doubles. So it's because it's the most social type of badminton, right?
Yeah.
And so let's say we analyze some of the world class players have been around for past 10 years. Let's say okay, so you have
Kim Monsu.
yeah. So you have the Korean players,
Yes.
right? You have the Chinese players, you have the Indonesian players, Malaysian players, and you have the Danish players.
Yes.
But let's say if you look at their track record for winning world champs and Olympics, overwhelmingly is the Chinese.
Yes.
Especially in men's doubles.
Yeah.
Right. Of course, the last Olympics, it was the Taiwanese.
Yeah.
But the Taiwanese have a very strong attacking style as well.
Correct.
Right. Okay. And so this is interesting.
And they're Chinese ethnically.
Yeah.
Ethnically, okay? I said ethnically.
Okay, we're not go there.
Okay, ethnically, guys.
Yeah. So this is an interesting analysis, I think, because one of the arguably most famous men's doubles players out there, if you think the most famous men's doubles player right now is that has had a very long track record is actually Lee Yong-dae.
Oh, yes.
Lee Yong-dae, right? So, but what characterizes Lee Yong-dae's style is very strong defense. But for some reason, when it comes to big world championships, so let's say in 2014, he lost to his Korean counterpart, other Korean counterparts, which is Ko and Shin.
Yeah.
Right. And they have a very different style from Lee Yong-dae because Lee Yong-dae is characterized by his very strong defense, but his attacking is not so strong.
Yes.
But he's extremely consistent.
Yes.
But when it comes to the big ones, he tends to not, he hasn't won, he's won a gold in the mixed doubles when he was very young, when he was about 18.
Correct.
But ever since when he focused into his men's doubles, hasn't been able to win the really, really big ones, like the Olympics and the world champs. I can't quite remember if Lee Yong-dae actually won the world champs. I don't think so.
I don't think so too.
I don't think so. And so why is it that when it comes to the big games, it's usually the pairs who adopt a very attacking style, the ones that win the big ones. And it's because the attacking style is actually reduces the risk of mistake more than the defensive style.
Correct.
So, of course, in Malaysia, we have Malaysian pairs. I'm not going to name anyone, but our Malaysian pairs are famous for defend, right?
Lifting,
Defend,
yes.
lift, defend. Of course, now the younger ones, their style is much more different now.
Yeah.
But of course, those days, right, it was just defend, a lot of defending, and then, counter-attack.
Yeah.
Okay. But the thing about that is that defending and counter-attacking, of course, is also a style and it's very legitimate in terms of its style, but you need quite a lot of skill.
Correct.
And the thing about skill is that it's got a higher margin for error.
Correct.
So that's how I draw the distinction.
This is exactly what I'm trying to say. And going back to your talent, right? The guy who buried the talent is not risk-taking. But at the same time, if you attack, then you have to think about probabilities of attack. Because if you think about guys like George Soros, when it really mattered, he doubled down.
Right, exactly.
Right, Kelly's criterion, you double down because what's the upside probability, what's the downside probability.
Exactly.
And that's why I was trying to, tap on your opinion or your thoughts on this, because as an athlete, when you play, it's a lot about probabilities. Are you going to take the line shot? Are you going to smash the body?
And and this is not like you can just think about it all day and
try to
buy at this stock price.
It's muscle memory, man.
You got 0.01 second to think about this.
And then like in a world championship, right? You the moment you start whacking it doesn't make sense. You'll be like, you still have to straight away think.
No, once you reach that point where you have to start thinking a lot, you need muscle memory needs to come into play and instincts as well.
Yes.
So that's where training comes in, right? But I think that part about risk is really. I think a lot of people misconstrue what risk is.
Yes.
Because like in Pascal's wager, there are a lot of things that you have to decide what to do. You can't be neither yes or no.
Yes.
Right? It's always either yes or no.
Yes.
And even if it's no, you're also taking a risk.
Yes.
For example, let's say, I want to invest. Yes. Then you're taking a risk.
Yes.
I want to invest. No. That is also a risk.
A risk?
Yeah.
Exactly. But
right?
people don't understand this.
Yeah, but exactly. So sometimes language can be a bit entrapping, right? Because I don't want to take the risk of investing. But they don't realize that not taking the risk, you're also taking a risk.
Yeah.
Right. So actually, I think in life as well, you can't avoid taking risk.
Yeah, I think it's similar parallels would be getting a romantic partner, right?
Yes.
A lot of people don't want to get into romantic partner because they take the risk of heartbreak. But they don't realize if they don't do that also, they're also taking other forms
of risk.
So if you do that, if you don't, might as well go for it, right?
Yeah.
Exactly. Yeah. So, and I guess as well, in investing as well as in relationships as well, there's a lot of trial and error. Right?
Yeah, exactly.
That's why I think one thing that is important to layer on the risk question, right, is actually recovery.
Yeah.
So a lot of people don't factor this in. They only analyze the risk from the perspective of whether the thing will work out or whether it won't work out. Mm-hmm. But they don't ask, right? Okay, if I do this, right, based on the probability, if I get it wrong, can I try again?
Yes.
And that's where Kelly criterion actually comes in. Kelly criterion is not merely how to calculate the risk and reward properly. It's based on the risk and reward, how much should you bet?
Yes,
exactly.
It's how heavy.
Yeah.
So if it's heavily in your favor, the heavier you bet, because it's more likely, right?
Yeah.
Then if it's the reverse, then you bet smaller. So I think that's probably something that I would add to this conversation.
Yeah.
But anything else you want to ask about the sports?
No. I think the second part, which was is it something that everyone should stomach? Because everybody sees the guy smashing at 400 or the guy being so accurate, but doesn't understand that
the work that's been put in.
The work has been put in.
And
that's where I wanted to ask in your opinion, what are the parallels you see? Because it's probably, MJ asked me how to hit backhands actually. I try to calculate.
They asked me, can you teach me? They said, this one need few weeks.
There was one game he was playing with me and said, hey John, how do you execute a backhand?
The backhand clear, is it?
Yeah.
No, just a basic one.
Just the, okay.
Yeah,
no, some context because I actually play more, back in the day, I play more tennis than badminton.
Oh, right.
So once you play tennis, right?
You don't have a backhand grip, right, in tennis?
No, you do, but your wrist is fixed.
I see.
It's not.
You actually hit, then you maybe flick at right at the end.
Yeah.
You are using your elbow more.
I see.
Than,
In badminton, you need to have quite a lot of wrist work because Actually, I think in badminton there's so many joints involved.
Oh yeah,
right? You have the shoulder, the rotator cuff, you have the elbow.
So even here,
the
even
wrist.
this part of the
Yeah, even just isolating this part, you have 3 joints to work with, right?
Correct,
Exactly,
correct.
you
know?
So he was asking me to teach him backhand while we were in the game.
Yeah.
I just said, it's okay. I think we can. Let's focus.
But staying on the topic of badminton, I think there's a very fascinating, and I think all Malaysians would like
Can
to
relate
hear,
to it, yeah.
No, would like to hear this part and to make this distinction. So you gave the exact. So I don't really follow men's doubles because I'm a casual watcher, which means I only watch
Everyone
singles.
watches men's singles, yeah.
Yeah.
Right. So I think I always draw like the parallels of Lee Chong Wei and Lin Dan, right? Because right, Lee Chong Wei right is always world number 1.
Okay.
But he always loses to Lin Dan.
Yes.
Right in the finals,
yes.
sadly. But I think that's something very interesting because the way I look at it is like what do you actually want as an investor? If you are like in Lin Dan's camp, you want that home runs and all that.
Yeah.
But someone like Lee Chong Wei, he's doing the small
Consistency.
stuff consistently. He's getting 5%, 10%, 5%, 10% every time.
Yeah,
And that's why he will always be world number 1, right?
Yeah,
Because
yeah.
it's like the Floyd Mayweather and Manny Pacquiao fight, right?
Yeah.
He was playing to the game and he was scoring points. Whereas the casual watcher is like, no, he's getting his butt kicked by Manny Pacquiao. Then after that, how did he win? He was like defending
It's
the
scoring
run.
points, yeah.
Yeah, so what what does this mean to you? Like how do you draw this? Like should we be a Lee Chong Wei? Should we be a Lin Dan when it comes to investing?
You want to score the home runs or do you
It's
want
not
to
easy to answer, right?
Yeah.
But you know what I'm talking about, right?
Yeah.
Because some guys can scrape 10%, 10%,
Yeah,
10%.
and that's Lee Chong Wei.
Or some guy wants like, no, I
Big
want 15, 20
home runs.
baggers.
Yeah,
one
then
shot.
you've got-
Okay, I think I suppose that these two systems and models, they're not exactly exact.
Yeah.
But I understand what MJ is getting
yeah,
at.
yeah.
Right. And so I think that's why it's even more important why investors choose to become long-term investors. Right. It's because that you have this extra component of time.
Yes.
Right. And I believe that the time is also equivalent to the little bit of extra something that Lin Dan has.
Yes.
Right. So I think, for example, Buffett also said that, you only need to have 20 punch cards, right?
Yes.
Something like that in order
Yes.
for you to get rich through investing, and that's it.
Yeah.
Right. You need to have that correct 20 so-called long-term trades.
Yes.
And then you've already made quite a decent amount of money,
correct,
right?
correct.
But what else, like the parallel, I suppose in this case, Lee Chong Wei can be represented as sort of like the more short-term trader or short-term investor because they try and make the little bit of 5%, 10%.
Correct.
Right? And I think the extra advantage, I suppose the benefit of the listener is that always think about time,
Yeah.
right? Even if you buy at a company at fair value or overpriced or at a price that's overvalued, you can still make money because you have time at your side. Whereas the short-term investor or the trader, so to speak, or technical analysis, that they're working against time. Right? They have to do this within this time.
Correct.
Of course, this occurs in the finance industry as well.
Yes.
But I think it becomes all the more difficult and stressful for you, especially when you want to work against time and you just say you're trying to push yourself, be like, I want to make 20% gain, or like, I lost this money, let me realize the loss and try to make it back.
Yes.
But like let's say a stock goes down 50%, in order to make it back is 100% gain.
Correct.
Yeah. So so I guess just to go back to that Lin Dan, so to speak, Lin Dan point, right? Is that with time, you're able to get those home runs.
And the thing I would add, I just realized also is that Lin Dan picks what competitions that he plays in.
Yes.
But Lee Chong Wei takes everything.
Lee Chong Wei. And Lin Dan is not, he's even okay with paying the fine because there's this, I think it's either the association or BWF that stipulates that you have to play a certain amount of tournaments.
Yes. Because it's for the sponsors.
Yes.
It's for the watch
but
time.
He doesn't care. It's like, I'm going to take a break.
Yeah.
You know?
Look at 3 of us.
He understands how to pace himself. That's very important.
Exactly,
yeah.
Look at 3 of us, man. Flaming Lee Chong Wei. So patriotic of us.
Yeah.
But okay, look, I think that was a really good discussion about how you look at investing, and I think that's very unique because I feel like, I don't know about you, John, but I feel like the answers given were not textbook at all.
No, definitely not.
Definitely not.
And that's why I wanted to tap on his, sporting
But
experience and all that.
I think we have to have the disclaimer. I do think that Lee Chong Wei is a national hero. He's done
yeah,
so much
definitely.
for our sport.
Yeah.
Please don't
the
hate
best,
on
man.
us for flaming Lee Chong Wei. We're just trying to draw distinctions.
We were just
between
trying to
sport.
put probabilities, put
It's
some
the way to
analogy
think,
to
yeah.
probabilities and all that.
Because some people also will say, yeah, it's true that maybe the Linden style makes more money or whatever, but like I can resonate with Lee Chong Wei, right? Like for me, I'm not going for the big wins, but the small wins over times, right?
Yeah.
So now we get into, I guess, the more juicy part about this, and maybe the applications of how you look at investments, right? I know that there are 3 companies that you, as a disclaimer, you own all these 3 companies, right? Your personal portfolio, and you own them, and obviously you're excited about them. So maybe let's start with the first one. I don't know which one to go first. Let's start with KESM.
KESM. Okay.
Right, so I know KESM is one company that I think you wrote in StockBit as well with some of your thoughts.
Yeah,
right?
yeah,
I think you
yeah.
cited Occam's razor as well, I remember. So maybe give us a sense of give us all listeners as well a sense of what they do and why it's in your portfolio.
Okay. So KESM, they engage in burn-in and test services only. So they're not an OSAT. So I think even there's some writers, it's best not to name names, right? But there's some writers out there where they publish their stuff and they sort of lump KSM together with
And OSAT.
Inari, Unisem, MPI, right? But
They do provide a small portion for EMS, but that is
It's
more
like-
to satisfy the customer as
Yeah,
a one-stop
yeah,
service.
yeah.
But it's not a significant part of the revenue actually.
It's probably about 5%
Yeah.
or 10. And so they primarily engage in burn-in and test. And so why burn-in and test services are important, especially to their automotive clients, is because that in the automotive industry, the chips in automotive industry, in comparison to other industries, they go through the most stringent testing.
Correct.
Right? Because those chips need to last beyond 10 years and beyond as well, especially for cars.
That's right.
So the growth narrative for KSM at the moment is that why this company, there's a growth catalyst for it, is that they stand to gain from the highest semiconductor content in cars, right? And so what that means is that they, hopefully when the chip shortage moderates, that they're able to secure, their clients are able to secure more chips, and then in turn, KSM is able to engage in burn-in and test for more chips because the cars have more chips in them now, right? Okay, so why has KSM not been doing so well? So in 2018, 2019, it was a US-China trade war.
Correct.
Right? So in the US-China trade war, then the supply chain gets disrupted.
Yeah.
Right? Less chips going to China. And, I think the OSATs in China as well are servicing less of the US ones over there. And so then that began like a sort of a decoupling of the semiconductor value chain in the world, right? Everyone wants to become self-sufficient now,
Correct.
especially the so-called mega powers, right? And now even including Japan as well, which is interesting.
Yeah.
Right? Okay, so and then COVID came, so factory lockdowns affected KESM as well.
Yes.
And then in 2021, it was the chip shortage.
Yes.
Okay.
Yeah, it's bamboozled, man.
Yeah, just non-stop. Okay, and
In
so
Malay, there's a phrase, sudah jatuh ditimpa tangga sama.
So, but why I find KSM interesting is that this is, and I think this is like the more of like the Monish Prabrai statement where like this is a company, is a distressed company in a distressed industry that's affected by temporary circumstances.
Yes.
Okay, and so I would say this is one of those tech companies that have not done well, have been laggards in the tech space, so-called semiconductor/tech space in Malaysia. But I do think they've managed to retain their value quite well. So why do I say that? Okay, so there's one thing about KSM that when someone looks into their financials, okay, first I would say that there are qualitative aspects of the company and there are quantitative aspects of the company.
Yep.
So in qualitative, you have business tenets and management tenets that you have to assess. And for the quantitative one, it's the financial tenets and the market tenets. So
Yep.
this is more like the Warren Buffett way kind of thing where you have different tenets. And so, yeah, I mean, if you read the book, The Warren Buffett Way, Robert Hagstrom kind of breaks down Warren Buffett's style of assessing companies to 4 tenets. So the business, management, financial and market. Okay, and so if you look at the financial part of KESM, what's interesting about that company is that the profits are going down.
Yeah.
But we realize that net operating cash flow
Is going up.
Has maintained a very healthy range.
Yeah.
So if you see from 2016 to 2021, its net operating cash flow is actually doing very resilient.
Yeah.
Right. So, but profit is going down.
Yeah.
So what's the story behind that? So then I looked into it and then I realized that depreciation weighs very heavily for this sort of a company.
Correct.
So it's a depreciation cost.
Yeah.
All right. So okay, for the listener that's listening to this, profit and loss is to do with accrual accounting.
Correct. Yeah.
Right. And depreciation and amortization takes into accrual accounting.
Correct.
Whereas cash flow operations, all these non-cash items are reversed back in.
Correct.
So in a way, the cash flow statement is basically saying that these things are arbitrary.
Yes.
Okay, in a way. Okay. And so then I realized that in the cash flow statement where they reverse back in the non-cash items, depreciation was the overwhelmingly largest figure in KSM. Then I realized, okay, so then I looked at its capital expenditure.
Yep.
Right. And its expenditure, of course, the capital expenditure is very cyclical. And I think that now that KSM has announced that they are spending 100 million for capital expenditure right now. And so what I did was that I assumed that over the long term, capital expenditure cancels out depreciation. So what are you left with? Operating cash flow.
Correct.
Right? And net operating cash flow. And
so free cash flow, you mean? Like if you cancel
Net of capex.
Yeah. So that means you take off the capex. You don't talk about capex.
okay.
So
Yeah.
So capex in accrual accounting, capex serves to offset depreciation. So you remove both. So there's like the so-called technique of Occam's razor. But I think in this case, you can call it like, or as I call it, like the Occam reversal. Right? You're reversing these things back into the statement, right? So then I felt that the operating cash flow was the most relevant part to look at, right? And so I used price over net operating cash flow to determine, to get a more accurate picture of the company's financial performance and financial health. And in this case, price over net operating cash flow is like PE. It's like price over earnings, right? In this case.
Yes.
So I think at this price is about 10. Is that cheap? Sounds cheap to me.
Yeah.
Right? And so and of course there are risks to KSM.
Yes.
Right? With the chip shortage, KSM heavily relies on their customers to secure these chips and then in turn outsource their burn-in and testing stuff to then outsource their chips to them so they can engage in burn-in and testing activities. And so knowing that they are a company that is going through a difficult time, but nevertheless temporary, I do think KSM will become a turnaround story eventually when the chip shortage moderates.
Sorry to interrupt this podcast. I know it's a little bit annoying, but I want to tell you something that I think can be really helpful to you. I can tell you're really interested in the stock market and want to learn more about it so that you actually know what you're doing, especially when today things are getting more complex and complicated. That's why we came up with the Stock Investing Blueprint, or SIB. It's our signature e-learning program that teaches you how to pick the right stocks most of the time, buy and sell it at the best possible time, and manage your stock portfolio systematically. It currently has more than 10 hours of content and it's growing. You'll also be part of a group of like-minded investors that can help speed up your learning process. To hop on the program, click on the link in the description or go to learn.firl.co/courses/SIB.
And so that is my take on KESM actually.
I see. What are the risks? I mean, so coming back to a few points that you covered about KESM, and for the context of some of the listeners who are not that familiar with the burn-in testing services. So if you were to simplify it into a layman's story or analogy, how do you start doing this kind of business? What are the things you need as compared to someone else like maybe, let's take an extreme example of an ATE player like a Vitrox, right? So the nature of the business, how would the balance sheet of a KESM differ from that of a Vitrox? Maybe you can come from that angle.
Okay, so basically they are a service, but in order to engage in these services, they need all these machines to do burn-in test.
Yes.
Right. And so we've also, I think it's publicly known as well that some of the machines that KSM buys or is consigned to them by their client is from Elsoft Research. So Elsoft is one of their suppliers of these machines.
Yes.
And so what it differs, let's say, from like Franken, which is like not so asset heavy.
Yeah.
And KSM is that KSM is very, very asset heavy. Right. And so that's why their machines, they become irrelevant after a certain number of years. And that's why they have to keep replenishing their machines over time. So that is actually the risk there. And why this company, in comparison to another tech company, let's say like Franken, is not so desirable.
And that's why the depreciation is also very high, right?
Yeah, exactly.
That was what I was trying to lead to.
Oh, yeah, exactly. And so that's why KSS deprecation is very high because of the high number of machines and then the capex as well.
From your reading and all that, how fast or how quickly obsolescence actually set into their machines and all that?
I think it depends on the cycle, but it's within a range between like 3 to 5 years.
Okay.
Yeah.
And from what was the latest announcement, I think it was 100 million capex, right? If I'm not mistaken. Were there any guidance provided by the company? How long will they need to recapitalize or recapex their business? Was there any hint from your reading?
No.
Okay. Next question I would ask with regards to KSM is.
Oh, do you mean like how they're going to fund their capex?
Probably there's one, but more I was like thinking, how many times do they have to spend 100 million?
Oh, right.
So that means
the cycle is also between like 3 to 5 years. So if you go to their cash flow from investing, the last time their capital expenditure was this high is in 2017.
Yes.
Right. But that also helps in offsetting the high amount depreciation cost there. So in accrual accounting, eventually it will look pretty decent, I suppose. Considering that their volume loading is good sometime in the future.
Yes.
And I do think that the management should know what they're doing. I think they do know what they are doing. And I don't think they'll be announcing 100 million capex just for fun,
Yeah.
Right? Yeah.
Actually, if you don't mind, can you drag back to maybe
how many?
20, let's say 2012 lah. Let's see if it's possible.
Can.
All the way back.
So actually we looked at KESM a while back. And so we also got excited about that 100 million in 2017.
Correct.
I still remember. Can you see the capex?
Capex here, over here. It's already plotted on the graph.
Okay, so it looks really. So here's what's interesting. Can you scroll down?
The blue is the black is the capex.
Okay, so here's what's interesting, right? So in 14 and 15, the mixture, right, of the pre-2017 capex cycle, if you notice, right, their business actually grew quite a lot, right? You're looking at like 65 million in operating cash flow going to 100 million, which is the peak, right? Over the past 10 years. So in 2017, when we were looking at this number, can you imagine, right? So obviously we don't see anything in 2018 onwards, right? We were excited because if you spend, let's say,
100 million.
70 million, right, odd, and then you get 100 million, right? So if you spend 100 million, what does that mean, right?
It should be bigger.
I mean, it will most likely mean that management is very bullish,
definitely.
They're expecting.
Correct.
Yeah.
So obviously, what transpired is that the operating cash flow was flat after spending 100 million, which is a failure.
Yes.
But as you rightly pointed out, it was a mixture of these three things: of the trade war, of COVID, and of the chip shortage.
Yes.
So the trade war, I think the damage is already done. Right. It's there already. I don't think there's any big reversal on that.
There's no reversal. Yeah.
The second thing of COVID, things are already opening up, right? We can travel. And so the big question now is actually the chip shortage.
Yes.
And for me, this current capex cycle of 100 million, the big question is this a 2014 or 2017 for KSM? And I think it hinges on the on the chip shortage. So you mentioned moderation, you used the word, right? what confidence do you have in terms of the moderation, and what are you seeing now? Because if it moderates, then right, 2014 is more likely. If it doesn't, 2017 happens again, and then it gets painful.
Right. Okay. So I think there are certain clues when it comes to data. So one of the things that if you want to pay attention to the chip shortage is vehicle sales in different parts of the world, right? And so iCapital, so thanks to MJ, I also subscribe to iCapital now. And in iCapital, they have this section where China on the move. And they're saying that the chip shortage has been moderating in China, actually, especially towards the end of 2021. So there are some clues there. Of course, not all the data are there. And of course, the chip shortage is ongoing at varying degrees throughout the world.
Correct.
Right? But so I think it's interesting that vehicle sales are returning, especially in a very big market like China.
Yeah.
Right? And even on the ground as well. Like for example, last year, like Mercedes, they launched so many models, but none of them were coming to Malaysia because of the chip shortage.
Yes.
And of course other brands as well were also facing the same problem, right? BMW included as well. And so now you're starting to see these models are appearing in Malaysia, right?
Yeah.
There are people buying the new C-Class, the new E-Class, right? Then okay, you kind of get a sense, like I think you can, in a way, on the ground basis, right? That you're able to feel like it seems that the chip shortage is moderating slowly. Of course, there are industry insiders, like for example, like there are industry experts from NXP. They're saying that the chip shortage may go on until 2023, or at least into the late 2022, right? But what's going on, like if you're paying attention to like what's going on around the world, is that everyone's building foundries now. Yeah. And especially their own, right? Every country wants to have their own foundry now and to start competing against TSMC. Yeah. So without trying to predict when the chip shortage will moderate, I rather prefer to say that, eventually the chip shortage will moderate. It just depends on when. Yes. But it's
the price you're paying for KESM worth the wait.
Exactly, and is the price you're paying for KESM, is it worth the risk? And right now, I think the price is about book value. Meaning is the price for net tangible assets. Yeah. So I would say that using net tangible assets as a gauge for buying tech companies is not no one really uses that metric anymore. But it does point to how cheap the company is. Correct. Yeah. Because there are people be like, it's 8 ringgit, it's expensive. Yes. It's like, oh my gosh.
Yeah. Right? It happens, man.
Yeah. Right. So I think maybe like for those people who are listening to this podcast, the price of a stock actually means nothing. Yeah. It's the price times the amount of shares outstanding. Yes. Right. Then you get the idea. So why a company's price can look so expensive is because there's less shares outstanding. Correct. Yeah.
I do have a contradicting view on the using the book value valuation for this particular company, is because obsolescence is a very pertinent thing for this kind of business. Yep. So whatever you put on book value today,
5 years is gone.
5 years is gone. You actually if
the company stops capital expenditure.
Yes. So I think investors, when you look at it, it's not like land where there's appreciation value to it, but a lot of the book value that is built into or baked into KSM, a lot of it is hinges around obsolescence.
You can't resell it.
Yeah. There was a joke that I've been to KSM's AGM easily close to 4 years now, 5 years, and Mr. Samuel, thank God, he somehow remembers me by name, because whenever I ask the questions, it's like, you again, John, right? But
John's you again.
Yeah, it's you again. So why I'm putting this up is because there were two stories that I think was pertinent. One was with regards to the share price. I think I'll let MJ narrate that about the division. But the one I wanted to narrate was this, and related to the book value, was I did ask him a question. Have there been instances where you buy a machine and became obsolete? He said, there was a time when the machine arrived and they never even opened it because it was obsolete by the time it arrived.
That's crazy, man.
Yeah, it's insane. It's
After
insane.
spending all that money.
Yeah. So he said just send it back, bring it back to the supplier. But it's already sunk cost, you see.
Yeah.
And I think as an investor, whenever we look at ratios, I think you have to look at it in
Be
nuance
very
of
careful,
the business.
yeah. Especially according to the nature of the business
Yeah,
itself,
exactly.
which is easier said than done.
Yeah. Because it's a lot of work.
Yeah, it's definitely a lot of
That's
work.
key, man.
The bonus one, you may want to share.
The bonus one? Oh, yeah. I mean,
The
I
P-Mentor.
don't know if I've shared with you this before. Maybe you've heard in our previous podcast or quick dives or whatever. Some uncle came up to him, shareholder, and then he just say, Samuel, like his son, like that. Samuel, Sam, nah, he said Samuel lah. He said, why can't you be like press metal, do bonus issue and then the share price go up, as if it's like mechanical. If I do bonus issue, which company do a lot of bonus issue but keep falling on? I think was it Sapura? No, that's Sapura. But anyway, it doesn't matter. So Samuel just say, hey, look, at that point in time, I think the price was like $18 or something like that, back in 2018, 2017. Say, look, you can't multiply wealth by dividing it. I personally, I don't think the uncle got it.
Yeah.
But I thought that was one of the best ways to describe bonus issues.
Yeah.
There's no bonus.
Yeah.
Right, you're not.
I think the uncle was stunned, man, because
It's just the same size of cake, but just in more slices.
Yeah, but a lot of people.
Yeah.
Look, I was having this discussion with a family friend, and he was calculating this company that had a very low, like had a lot of shares, like a lot of shares.
A lot of shares.
And you say, what? The EPS is only 0.004 cents? How so low? Is the yeah, bro, but you check how many shares you got lah.
Yeah, exactly.
Yeah, so it's like
Exactly.
it's very basic, but it still catches people.
actually we you know what a lot of the times that MJ and I we get stuck, not to say get stuck now, we get stumped is that questions like this always emerge whenever we talk about.
Yeah.
Rather than they ask about the business side of the questions, they always ask about what we call the capital changes or capital exercises that always happen. Yeah. And it always sometimes I also struggle because it's like they do, let's say, warrants 3 for 2 or that kind of thing. Virtually, you have to take a piece of paper and start calculating, But what if you think about it, what's the exercise for? If I just divide it into, is the company asking money for you?
Liquidity, bro.
Yeah, or is it just dividing up more cakes, slices of cake? Simplify. It's just these two only. I mean, if you think about it, they give you free warrants, they give you free bonus and whatever.
Yeah.
Warrants is what? It's conversion. It's a rights law.
Yeah.
It's as simple as that lah.
Yeah,
Meaning
yeah.
more money lah. If
You
you
know,
do
is your
bonus,
dilution worth it for whatever the company is going to use for money?
In economics, there's no free lunch. Right?
yeah, there's no free. Precisely, precisely. But the words that is used to package, it's like the Gary Tan analogy lah. Golden pepper wrapped.
Yeah.
What's the essence inside? Yeah.
I just want to say, I just hate all those, 3 warrants and then 3 warrants after 2 to 7 bonus. Those are the worst ones.
Yeah.
Absolute pain. I don't know why they do
what's
that.
going on?
Yeah.
So
And then
anyway,
when you try to sell the warrants, it's like, oh, odd lots.
Yeah,
Oh my
odd
gosh.
it's like 66 shares of whatever dash WA.
Yeah, like paying 66 and then you have to sell it and then like the brokerage fee doesn't cover the proceeds. It's just like, but you just want to sell it anyway because
Exactly. It makes it look ugly, right?
Yeah, exactly.
But yeah, anyway, anything else you want to add from KSM before we move on?
Okay, so I do think that yes, I do think there is value in KSM at this price. Even between the range of 8 ringgit plus to 12 ringgit, I think there's good value in KSM. But of course, for the people who are looking at KSM, as we mentioned, the business is very asset heavy.
Yeah.
And so the challenge of analyzing companies in the so-called semiconductor value chain is knowing which part of the value chain they are in
Precisely.
as well.
Spot
Because
on.
even if I mentioned just now KSM versus Frontcan, but they're totally different size.
Oh,
They're
yes.
different size of the galaxy.
One use seed, one use chemicals.
Yeah.
exactly.
And the best part is that one is right at the front, one is right at the back. Actually, if you think of it,
Exactly.
yeah, it's one is right. at the-
Before the big guys assemble the stuff, that's when KSM comes
Exactly.
in. Right?
Yeah.
So for me, in the end, a person has to assess themselves. Okay, this is the nature of the business, and this is what they do.
Yeah.
And you find out what the growth catalysts are.
Yes.
But at the end of the day, I think entry price is very important.
Oh, yes.
It's super important. And so I think like we were talking about, like DNO as well.
Yeah, exactly.
And like, okay, DNO is a very fantastic, exciting company, but depending of your own estimation of what the forward PE is or the current PE is, it's very different.
Yeah.
Yeah, it's definitely very different, and they're complete different businesses. So the question is like, are they comparable or they not as well?
Yeah, exactly.
And sometimes it's different depending who you ask.
Yeah.
Correct.
That's right.
Yeah, but I mean, I do believe that we are of the opinion that it's like comparing a green apple to a red apple or an apple to an orange.
Correct.
Yeah.
Yeah.
That's true. Okay. Next stop. Let's do ANCOM. So ANCOM is very interesting because you talked a lot
exciting.
about margin of safety, but optically at least, ANCOM,
It's like a growth stock.
that it doesn't seem to have a margin of safety, right? I think if you can go on the valuation step.
Yeah.
So
I'm trying to close this to go value. Ooh. What on earth did I happen?
Scan your finger. No, I think you X the one in the bottom.
Yeah, cancel this guy first. Okay. What are you doing?
This is where you put a very convenient advertisement.
Yeah. A pop-up and...
Yeah, so if you click on the valuation part.
can't see because the cameras... Okay, got it.
Yeah, so... if
Price to sales or price to earnings?
What's the price to earnings?
Price to earnings in Ticker is a bit tough. It's actually here. Last 12 months.
I don't think it's there.
Where's
No, it's not. Usually Ticker...
Yeah, I think we can go to Google. I
Yeah,
guess.
the best is Google.
Yeah, it does render a bit differently in Ticker, right?
Yeah, because they're using EV as well, which, to be fair, is a bit more accurate, but it's fine.
There you go.
Yeah, so it's like
28.
30 times earnings, and it's not a tech company, right? Which is why I say optically, it doesn't look like it has a margin of safety. But of course, that's why you're here. And maybe for actually my benefit as well, I know they're into fertilizers. I know, what was it?
Monsanto.
Paraquat.
Paraquat, yeah.
Paraquat.
These are the buzzwords I know for ANCOM.
I think better not mention Monsanto with ANCOM. You get in trouble. ANCOM management start messaging, hey, why you mention
But yeah, so maybe give us a sense of what they do and then why you're excited about it, why it's in your portfolio.
Okay, so ANCOM engages in two segments. So the first one is the agricultural chemical segment. In Southeast Asia, they are the only sole producer of active ingredients. And active ingredients, AI is short for active ingredients. And active ingredients are used in herbicides, pesticides, and fungicides. The second segment that they are engaged in are in industry chemicals. And in industry chemicals, they are one of the two ethanol producers in Malaysia. Okay. And so what is...
So the second one being? What's the second one?
One of two ethanol producers.
Do you know the
in
second
Malaysia.
one? Do you happen to know the second?
No, I'm not sure. I'm not sure.
Sure.
I'm not sure at this point actually. But what is interesting about ANCOM is that they have industry chemicals and agri-chemicals, and the agri-chemical segment stands to benefit from the higher commodity prices in agriculture. And so they produce herbicides like Diron, MSMA, and glyphosate, and they are applied to crops such as corn, pineapples, soybean, palm oil, and a lot. It's about 11 lah. It's about 11 different types of crops, right? And so they when commodity prices go, when agricultural crop prices go up, the price for their products will be higher in demand. So they stand to benefit from that. But actually the larger, they command a larger earnings share from their industry chemical segment, which is buoyed by the higher crude oil prices currently at the moment. And so I find the company interesting. For those that know that the Ukraine and Russia war have also caused an increase in agricultural prices as well. So I would not go as far to say as ANCOM is direct beneficiary of the war. Go invest, right? But there is something to look at in ANCOM for that. So that is some of the business tenets. They are also engaging in acquisitions. So now they've fully acquired Nilex, I believe. Yeah. And as well as Shenong Animal Health. So now the direction from the company is that they want to become an integrated with like one-stop shop.
I see.
When it comes to agriculture, industry, chemicals, and trading as well. They're going to become integrated. So I think that's very interesting, and I think it's quite an exciting story for the company. Financially, it's also very interesting. If you look at their net margins are increasing.
Okay.
So is their earnings, of course. And then if you take a look at their balance sheet as well, their net gearing ratio is also going down every quarter.
Okay.
So financially, the company is looking more and more healthy as well.
So before we go on, I think what's interesting is that this is one of the few companies out there where the revenue is more or less flat, right? Over 5-6 years.
Right.
But the net income is going up, right? And is that a result of commodity? You're saying that the commodity prices rising is the one giving them
So
income?
I would say it could be, from a method of deduction, it would seem that they are more or less selling the same amount volume of commodities, but at higher ASP. Yeah.
I see. Okay.
Because of the higher agricultural crop prices as well as the higher crude oil prices.
But then wouldn't that is with the assumption that because their raw material prices are going up, they can actually pass through this cost to their customers as well, right?
Exactly. Yeah.
Because if not, then they will be squeezed in the middle where there's a fixed price to the customer and yet raw materials for their chemicals. Because are the suppliers to what they produce local, or are they where are they buying their raw chemicals from actually?
Okay, so it's interesting. That I think their raw chemicals. So okay, let's talk about their agri-chemical side. So they are the manufacturer of that.
Yeah.
And so in terms of raw chemicals, I do not yet quite understand the supply chain of where they supply the raw chemicals. But I do think the interesting part is that they are able to manufacture the active ingredients as well.
I see.
So that's where it points to their economic moat and their competitive advantage, especially in the regional area.
I see. Am I guessing it's a petroleum based kind of fertilizer, right? So most likely some gases, either hydrogen or whatever.
But specific suppliers, I don't think the management has disclosed this.
I see.
Yeah.
I see. But in terms of raw ingredients, have they disclosed it? Because I don't really know about this stock.
Not as far as I know.
I see.
Yeah. But I want to understand also because like John, we have not looked at this, but we know that, look, commodities all the rage, right? In the past couple of weeks or 3 months or a month, 3 weeks or a month. How does like crude oil actually like benefit these guys? Like crude oil has gone up, like it's like 130 now, something like that. That's
I think
crazy.
it's dropped like around. I think Brent is below 100 now. I think.
Yeah, just dropped.
It's
It
just
went
dropped
to
below 100,
130,
right?
then came down.
Wow. Okay. So what is like how does it actually like I guess positively impacts ANCOM or it doesn't? Maybe you can educate me.
Okay. So when it comes to the industry chemicals, you know that they are made out of crude oil.
Yep.
Right. And so crude oil is an essential part of the manufacturing of ethanol.
Okay.
Right. And so when crude oil prices go up, the prices for ethanol goes up. And so when they make their products in industry chemicals, naturally. So what I think the good thing about this company is that they're able to not only pass on their material costs to their clients, but they're also able to have an increasing margin as well. So I do think there's a pricing power to that. Yeah.
Okay.
So that means they can actually increase the price higher than the cost.
Right. Okay. So what's interesting right now is that there's the recent paraquat ban in Thailand
that's what I was going
and
to.
even in Malaysia as well. And I think in different states of the US, some states have decided to ban it and some states have not. Okay. And so I think this relates a little bit to the risk behind using agrichem products, right? So for those who remember the scandal with Monsanto's product Roundup, right? So Roundup is one of those products where some people claim that it causes a skin disease.
I see.
Right. And so, of course, you could say that ANCOM is a little bit like Southeast Asia's Monsanto, but they are not Monsanto. Okay. So their products are not Roundup, right? And so I think paraquat was banned for a very similar reason, that they pose very, very, very almost fatal health consequences for some of the people that were using paraquat.
I see.
Right. And so I think this is where ANCOM's products, assuming that their products are safe, comes in.
Okay.
Right. So they're able to grab more market share from the paraquat ban. So in the latest ANCOM investor briefing, they identified that their product Monex, which is a mixture of MSMA and Diron, two different types of their herbicide products, as a suitable substitute for paraquat. Yeah. So that's very interesting. So I think Peter Lim, who was on this podcast as well, that drew this distinction where like there are quite a lot of companies who aren't able to grow because they're targeting the Malaysian market.
Understood.
But what's interesting about ANCOM is that a lot of their products are exported outside of Malaysia.
I see.
So in terms of geographical breakdown, excluding Southeast Asia and Malaysia, about 50%
is exported.
Is exported to the rest of the world.
I see.
Right.
And I think about 15% is Southeast Asia and Malaysia is about 30%.
I see.
And so one of their main clients come from South America and Brazil, and then I think followed by the US.
Did they disclose the client's name?
Okay, so the management has not disclosed specific clients from Brazil, but if you do a little bit of digging, they do disclose a few Malaysian clients in the internet. So I think some of their Malaysian clients are FGV and IOI Corp.
I see. So mainly palm oil industry.
Some of them lah.
Understood. I didn't realize Monsanto has been bought over by Bayer. Bayer owns them now.
Yeah, so I think Bayer's been doing a lot of their PR work for Roundup, because Roundup is the Monsanto is still going through a lot of court cases. I'm not sure if they're still ongoing.
Yeah, it says here June 2020, Bayer agreed to
there
pay
you go.
numerous settlements.
It's been finished by
it's non-stop one actually.
Yeah.
Interesting. So I guess, would you say that part of the thesis is simply that, not just improving margins, but also grabbing these market share from these paraquat heavy sort of industries? Would you say that is the big thesis to ramp revenue up?
Yes, I do think so.
Right.
I do think so. And what's interesting about just this, so we're just talking about the qualitative side of it.
Yes.
So now financially as well, we know that the balance sheet is doing better, net profit margin is doing better. And of course in valuation we use PE, right? So right now the company is trading at a 12 times trailing of about 30, right? And so why I think this company is able to grow in the future as well is that there's room for PE growth as well. But this is more to do with like relative valuation, right? Because Hexstar is actually, interestingly enough, Hexstar commands a PE of about 60, right? But of course, Hexstar at the moment, their margins are a bit better than ANCOM. But I think so this is one of those things, right, where like, okay, so like you find the closest peer of this company on the bourse, right? And then you go like, okay, is it possible that this company is able to catch up in terms of PE as well? And so Hexstar is a very respected competitor to ANCOM. But I do think that what's interesting about ANCOM's proposition is that of the room for growth in ROE, room for growth in PE, net profit margins, as well as earnings. Yeah.
Great. Something along the lines of what I say. I think people are quite enamored with the tax, the logistics sectors, but I think one thing the COVID scenario actually portrayed was also our lack of understanding of food security as a team, because until and unless we just take for granted that the shelves in the supermarket would be stocked and all those kind of things. And the moment COVID hit, that's where okay, vegetables come from here.
We eat so much rice, and apparently we're net importers of rice.
Oh yes.
Right.
So
I didn't even know before all this that we get a lot of our vegetables from Cameron Highlands.
Yeah.
To me, Cameron Highlands was just a place I visit for fun, right?
Yeah, exactly.
They know they were that important.
Yeah. So great. ANCOM,
All right. So
Next one.
anything else? Yeah, you want to add management, whatever, before we move on?
Okay, so what's also interesting about management that I believe the CEO Lee Chun-hui has come on board as CEO from as either 2018 or 2019, around that. I think between 2017 2019. So I think what's interesting is how he's directing the company.
Okay.
And I think, of course, he's trying to turn the company to a more integrated company. But what's also interesting is that he is also publicly stated that he's been busy mopping up ANCOM shares as well himself. Yeah.
So
And at all prices, even at the peak as well.
Wow.
So that's interesting. You can see that the managements themselves are bullish on the company.
Okay.
Otherwise, they wouldn't be buying their own company shares.
understood. Yeah.
I would say it's not 100% certain that the stock will go up, but it's an indication of the management's.
that's top glove, right?
Yeah. Well, yeah, then stop glove as well.
So yeah, for those of you who don't know, it's okay. You don't need to know, but those of you know, you know. If you know, you know.
Yeah.
Okay, so
Next.
we move on last. I only have, so we talk about one more stock, and then we maybe talk a little bit about how you manage your portfolio and maybe a little bit about your macro views towards the end. But let's start with PMB Tech. So PMB Tech, I know a little bit more, right? And they're good friends with First Metal, right? Very good friends.
Same founders.
Well, it's
Exactly.
the same.
They are brothers, right? These two companies.
They're the Kuhn
essentially, right?
family,
This is like the DNO and MFCB
Yeah.
kind of situation.
Yeah.
So, maybe give us a sense of why you own it and,
But
again,
maybe before that, what do they do?
what do they do and why
Okay, so what they do is that they manufacture high purity silicon metal, and silicon metal is used in three very fast growing industries right now. You have energy storage, solar cells, and semiconductors.
Yeah.
So of course, for those who are in the sort of the nitty gritty tech space of semiconductors, know that semiconductors are moving from a very high degree of silicon based material to silicon carbide,
Correct.
as well as gallium nitride as
Yes.
well. And so they are so this is the so-called demand side, right? You have the electric vehicles using high amounts of silicon. So for those who are interested in even Tesla is very very bullish on silicon, right? They find silicon is absolutely a fantastic material to use for their batteries.
Yes.
I think it was 2020 Tesla battery day.
Yeah.
They talked about silicon.
Yes.
So that was interesting. And it's around the same time as well that, PMB Tech started getting a little bit more coverage in terms of investor awareness and stuff like that.
Correct.
So you have that, and then you have the silicon and solar cells.
Yep.
As well as what was it?
I think
Battery storage, solar cells, and semiconductors.
Correct,
Right. So
semiconductors.
semiconductors, and so as the amount of semiconductor sales is poised to increase, and so is the higher demand for silicon metal. Right. So you have the demand side for this. Okay. What about supply? Because at the end of the day, we're talking about a commodity, right?
Yes.
And a commodity is subject to the market forces of supply and demand, right? So that's the demand part. So you feel like there's a pull there in demand, right?
That one it's settled, right?
Yeah, it's done.
It's
Like
that
everyone knows that these are very, very, very
demand,
fast growing industries. So what about supply? So the thing about silicon metal right now is that some of the largest exporters of silicon metal, besides the ones in Europe, are in China. And because of the China decarbonization policies that is ongoing in China, there's a lot more plant closures due to their cut
Really?
electricity costs.
No way.
Right?
Okay.
Because China wants to become more green, right? And so all of these plants who source electricity from coal-powered generators, for example, are being closed down.
Yep.
Right. So then you get that little supply shock there. Right. So you see that pull and demand.
Yeah.
And then that drop in supply.
Correct.
Right. And so now there's this thing because of ESG that plants who are able to source their power from renewable energy is becoming much more lucrative.
Yep.
And conveniently enough, PMB Tech is in the Sama Laju industrial zone.
Yep.
Where they're able to source energy from hydropower. So tick ESG, right? Okay. And so I think it was Occam, right, that published this map that they're actually not a large amount of plants that are silicon metal plants.
Yeah.
They are able to generate their power from renewable energy sources.
Yeah.
So if you see the trend there, but because of ESG trends, now there's more emphasis on people trying to discriminate between plants who do this and plants who are, especially the ones, for example, in China, they are the ones being closed down because of the China decarbonization policy. So supply, demand, right?
Yeah.
And so for those people who've been tracking silicon metal prices, of course, we have Rondi Yunanda to thank for in StopBit, who's been posting these prices on StopBit.
Yeah.
And I believe that so there are three markets where the prices are being tracked: the US, Europe, and China. So China, right? Also in Europe, let's say in the US is still actually, the prices are actually quite close to all-time high.
Okay.
And then in Europe is sort of like in the middle. And in China, it dropped quite a lot and now it's recovering. Right. So there's this thing that's been ongoing. There's this discussion on StopBit right now. So, okay, for those just disclosing that PMB Tech is not a so-called original idea for me. It was an idea that I got from users in StopBit. And then I did my own research myself. And okay, there you go.
Yeah.
Is this today?
No, I think it may be backdated, but this is from
this
Reuters.
is at its peak, I think.
Yeah. When was this?
September.
September.
Yeah, September.
6 months ago.
September, 6 months ago.
Yeah.
So the prices in China have dropped quite a lot, but it's starting to recover again. So one of the inferences that one of the StopBit users has proposed that the reason why the Chinese market the prices have dropped in the Chinese market was because of all of these plants that were actually because of the high electricity costs. They were actually quickly trying to sell out their silicon metal at very cheap prices.
I see. So there was a price dump.
Yeah, so there's a price dump. So now you see that the price is slowly increasing again in China, which is interesting. I think you're able to find the China prices on silicon metal, I think.
Yeah. So what's also interesting, and maybe some context for the viewers out there, is that to run any steel plant, I mean, the days of Andrew Carnegie, the steel magnets and all. In Malaysia, for those more veteran investors, they will know that steel companies in Malaysia didn't really make money actually. The Pewaja Steels, the Southern Steels and all that. And I guess it was, one is the abundance and the use cost,
energy.
but more important was the cost actually. That was the point I was trying to make. And P Metal actually owes a lot of its success to the energy cost that it got a very
Dam, right?
Yeah, the very favorable
Samalaju Industrial Zone.
Yeah, which is tied to the grid for the Bakun Dam. And now I'm Sorokian, so they're actually building a Balai Dam, which is going to be even bigger. And I think that rides on the thesis of cheap renewable energy at a certain cost.
And very green,
Yeah, very, very green. Yeah, so I'm going
Or blue
Get to have silicon metal and the butterflies get to live as well. Everyone's happy.
prices. China, let's see, what do they have?
I do have a question. This is, I guess, a bit more technical. Like you said that there was going to be a shift from
silicon carbide to gallium
carbide,
nitride, right?
Yes.
Yeah.
Sorry, it's from silicon to silicon carbide. Is that what you're saying, or the other way around?
Now that there's a lot of R&D going on, right, with gallium nitride as well as silicon carbide.
From a end product perspective, is it this shift happening? Is it like it's going to reduce costs for battery makers or solar cell producers?
And then also efficiency, and they're much more resilient to higher temperatures as well.
I see. Cool.
Yeah,
So,
This is what we call the Silicon 2.0 shift, because in the past, so if you look at how processors are being built, it's usually, especially logic processors, a lot of it require very low current. That's why, battery life, if you are on an ARM architecture, very low amperage and all that kind of thing. But as we move more and more into automotive electronics, we move more and more into 5G, where you need high frequency kind of response as well as high power because of the attenuation loss that you get, especially 5G, right? Because the distance is so short. you actually need very high current electronics.
And these sort of materials are the ones
They're more
Because
resilient.
it's
Yeah.
more resilience. There's what we call lossless.
right.
Less lossless energy,
Yeah.
and then your attenuation and your signal propagation gets better. That's why the leaning towards silicon carbide and gallium arsenide is actually to widen the current usage. Because right now, a lot of logic chips are built on silicon are at a very low current usage.
Because I guess what I was trying to understand was the shift that is happening now a result of a technical barrier or is because of a demand barrier? It's more demand.
It's more both a technical barrier and a demand barrier. Because for silicon itself, physics doesn't warrant that for silicon to hit that kind of a high limitation, especially for frequency response as well as current draw. So
Right.
you
Well said.
actually for a laptop, right, you don't need 20 amps.
Yeah,
You
of
probably,
course, of
yeah,
course.
yeah, right. But for an automotive electronic, especially for power electronics for a car,
Correct.
you just imagine if 50-60% of your car content today it's EV, it's electric,
Yeah,
electronics, right? You virtually need a battery. You don't want to have the battery that's so big, but even if you have a battery that's so big, you need some sort of a regulatory circuit to be able to contain it, and that's where this additional material actually comes in.
Right. And,
Yeah.
so it came together. It's more like, okay, now there's all these things that people want that's
Yeah,
higher powered.
yeah, yeah.
And then the tech
Yes.
right now enables the shift from silicon or to silicon 2.0. lah.
Correct. Because for most laymen, you just want what you see on the surface is usually, I turn it on, it's like
Yes.
it's lights. But all this comes at certain technical barriers that will need to be broken, you see.
That's
yeah.
where silicon. And of
said.
course,
Yeah.
then the thesis is that regardless of whether there's a supply shock or all that, because the not press metal, PMB Tech has that energy cost advantage.
Yes.
They stand to take advantage of this, similar to their big brother press metal. lah.
Yes.
Just that press metal is more aluminium, lah, right?
Yeah. Aluminium has a more general usage, whereas silicon carbide and also
specific to-
gallium arsenide, more specific, but growing. It's a growing
Correct,
time.
correct.
It's a growing
Correct,
time.
correct.
Yeah.
What's interesting as well is that it's also owned by the Kuhn family,
Yeah.
which is press
Exactly.
metal, right? So
Yeah.
they got
Actually, it's a
that.
copy paste if you think about it.
Yeah.
almost a
So,
copy
but
paste,
the
right?
cool
It's
thing
just-
part is that you're catching it a bit more earlier now. Press metal, like 10 years back.
10 years
right?
back. That's right.
Press metal 2.0, right?
Yeah.
But of course, in the context, just some context as well. And this is also, of course, not a buy call to the listeners
of
there,
course.
because the price now is more on the toppish side, I think,
Yeah.
at 18 ringgit.
Yeah.
So when I bought it, it was about between 10 to 12 ringgit.
Right.
Of course, that's even later than some of the users on Stop It. But even
We
then,
have
I'll-
to call out
Tap
Mr.
dance.
Tap Dance, right?
Yeah, thank
Yeah.
you, Mr. Tap
Mr. Tap
Dance.
Dance. You know who you are,
Yeah.
right? So so you continue.
Yeah, so at that time when the price was hovering between 10 to 12 ringgit, so for something like a commodity player like PMB Tech, actually the valuation is just a tiny bit more complicated, but it's not that difficult.
Correct.
So you know that their capacity per annum is about, I believe it's 72,000 tons
Yeah.
a year, right? So then conveniently enough, silicon metal is sold by the ton.
Yes.
Right. So
Just multiply.
Yeah, just do the multiplication.
Actually, that's the beauty of manufacturers,
Yeah.
Capacity,
Yeah.
average selling price.
Done.
You
Done.
do some math,
Done.
right?
Right. You do some math.
So
that's
I
it,
did,
right?
yeah, and I just did some conservative estimate of this year's commodity price per se, because God knows what the price would be in 2023, but that was back in 2021 when I was
Yeah.
doing my valuation. So
Yeah.
I think the average selling price for this year, I just took maybe, I can't remember, it was in RM, I think it was
Renminbi?
40,000 renminbi or 26,000 ringgit. And it worked out to be of a value of about 18 ringgit at that time. So I had a significant margin there between 10 to 12 ringgit to 18 ringgit. And now it's trading exactly at that price.
Yeah.
Right.
It's
So-
dropped quite a bit though. To
Yeah.
50
It was actually just above 20 ringgit.
Yeah.
Yeah.
So I guess going
Yeah.
back to some of the principles you were talking about earlier on, right? Do you think they're at a stage where if they're going to achieve what is expected, then it's going to be not minuscule, but certainly modest gains. But then if, let's say, there's a hiccup along the way, then there's going to be a rude awakening in terms of expectation. Do you think we're there, or maybe you have a different view?
Sorry, this is in terms of silicon metal, is it?
No. Like for
Market expectation?
for PMB Tech. Yeah, I'm talking about the expectations because now I think there's high expectations that. No, I'm assuming right. There's a high expectations that if they do well, then the gains are like okay. But if there's a hiccup along the way, then
right. So like
is that where we are now, or you think?
Yeah, I do think so. Actually, I do think so. But actually, today's price is what, 15.98. Okay. Still, I would say still topish.
Right.
Still topish because of course, in the end of the day, it all comes down to your estimation of the silicon metal price.
Yeah.
But okay, this is where we go back to like Pascal's wager again, right?
Yeah.
At this price, how much do you stand to gain, and what's the probability of that? How much do you stand to lose, and what is the probability of that?
Correct.
So,
I think if some of the math nerds out there who want to have a go, they probably have to calculate all the silicon metal suppliers supply versus demand and try to equate that into an equilibrium
price is like a sustainable price.
So
right?
that's what MJ and I did with the research team for the gloves to try to estimate some sort of an ASP between supply and demand of capacity being built by the new players, especially in China, versus that of the existing players in Malaysia adding on to their lines. Because, I mean, put it this way, no high prices or no high margins will stay on forever.
It's not sustainable.
Yeah, it always comes to an average price where it's not too painful for the buyer, but it's also not too lucrative for the seller in a way. I think that's where economic comes into play.
But what is I feel interesting and something to think about is that the three things that are driving the company, which is solar cells, EVs, and then a battery. Semiconductors is that the volume that they have can offset, the end products, right? They can offset whatever price decline. So we know, for example, like car, solar cells, and semiconductors, the price drops over time, like your computer, and your car, and all that, right?
Yes.
But because of the sheer increase in volume globally, it will offset any price decline. So I think that's what makes it interesting for silicon and gallium nitride and all this, is because it seems to me that the likelihood of the price staying where it is or even going up, maybe slowly or very quickly, is actually decently high, right? You wouldn't rank it alongside latex, for example,
exactly.
or butadiene, right? For example. So I think that's the interesting element, and so it's again very similar to precious metal, where the owners only have to think about cost.
Yes,
they don't have to wonder about demand, right? So I do want to get something interesting.
Before that, there's an interesting part about silicon PMB Tech's business as well, which made it extremely appealing as well at that time, was because of its operating leverage. So the more capacity that they're able to utilize, the more that their profit, their margin grows as well.
Yes, exactly.
Yeah, that's very interesting.
Yeah. Because as a manufacturer, your fixed cost is kind of like fixed, and whatever extra you made either through ASP expansion, is really straight to bottom line, right?
Yeah. So that's an interesting thing. But of course, I would say that this is kind of a non-Buffett way, right? Because Buffett said that the most riskiest investment is when it comes to commodities, because a company that manufactures these commodities are indistinguishable from one another.
Correct.
Right? Except if they are a very low-cost producer.
Correct.
And I think that's what PMB Tech is aiming for.
Yes.
To be a global low-cost producer by 2025.
Correct.
Of course, then that's where you have to believe in the management. And I do think the management has to track record for that. Yeah.
Literally.
Yes.
Actually, this is where
we don't want to put too much expectation.
But I want to have some fun. Actually, you can pull up precious metals price.
Okay.
Precious metals market cap, right?
Yeah.
No,
because actually, let me ask you guys, because you guys look there, and then John, like you're in technical and all that.
Yeah.
Do you think, right, that in terms of size, quantum, and all that, considering the comparative growth between aluminium and silicon carbide / gallium nitride, do you think they will ever match and reach? Because I would assume aluminium is a lot bigger than
aluminium is a lot bigger because application wise it's so big. You think about the generalistic is the cheapest, considered the cheapest. The only thing that aluminium loses out on is actually conductivity. Because conductivity, the best is actually gold.
Yeah, but
Yeah,
there's
but
only so
gold,
much gold,
there's only
right?
so much gold, right? Right. But aluminium, you think about it, aircraft, cars, so many things.
Buildings.
Yeah, buildings, so many things. Whereas for silicon metal, I think from my personal opinion, I think the TAM is growing because the application for using it is growing.
It's huge,
I think the question is room for growth. The growth.
How much?
there,
Yes. How much room for growth? How much are people willing to or developing new products, for the lack of a better word, using this element in a way. It's not even an element. Sorry, it's a
Compound, right?
a compound.
The
Yeah,
chemical
it's a
compound.
Yeah,
right?
it's a compound. Yeah.
So look here. So like PMB Tech is like 3.5 billion. Then our good friend Press Metal is 50 billion. Again, not financial advice. But here's the key.
Financial advice.
I think one thing that's
By the
going to
way.
drive, right, if it ever like goes from 3.5 to close to 50, right?
Yeah.
The key, guys, is bonus issue. We need that, We need the bonus issue, Like, it worked, right? Press Metal, so like, right? See, Press Metal's, guys, Press Metal's price is lower than PMB.
Yeah.
See, these are 60
If I'm
million,
not
6
mistaken,
ringgit.
Press Metal did easily 4 to 5 times a bonus issue. Easily.
It's the key. We need to bring
Bonus
Press
issue
Metal
is the
price to
key.
160. You know?
Yeah.
Probably tell that to MPI as well.
Yeah. I think MPI is already considering, maybe, I'm my guess.
Yeah, I mean, if you look at so what's interesting is that like it's even though the market cap is smaller and all that, and the growth potential is a lot higher, but the valuations, right, for PMB Tech is like 30 times, and then you're looking at
And then
50 for Press Metal.
Yeah,
So,
right?
Like,
Yeah.
P growth.
Interesting,
Market cap growth,
And not only that,
Interesting,
if you look at P Metal, in terms of other aluminium producers in the world, I think their big advantage is, yes, it's cost lah, but if you talk about operating, who are the other? Alcoa. You heard of Alcoa?
Yeah.
So this is for P Metal, is it?
Yeah, for P Metal,
Okay.
Alcoa share price. I don't know this industry very well, but these are the names that I can.
So it's about 30,
30, 32?
but it's okay. We Malaysia we got premium.
Yeah.
Scarcity premium.
Scarcity.
Yeah, it's
premium.
world's 6th largest producer of aluminium, Alcoa.
Yeah.
The reason why I remember Alcoa, you know why not? Earnings season, they'll always be the first to announce results.
Right.
Yeah, and it starts with A. So so that's why it always rings a bell to me.
Okay,
right?
okay,
Alcoa,
okay.
Yeah.
So anyway, for PMB Tech shareholders, 50 times earnings.
Yeah, I
Fair
think
value.
it's definitely.
Okay, I'm not
Fair
financial
value.
advice, but it's really interesting lah. Like, and you can see like how management behaves. Like they find all these key patterns. Like, I look at I want to be in an industry where the demand I don't have to think about it.
Yes, exactly. Yeah.
Yeah, and I just need to control costs. I need to hopefully generate operating leverage, and that's it.
Exactly. And hopefully no more lockdown.
Yeah.
Yeah.
But what would be interesting is to figure out, right, if there is any country in the world that has, our kind of costs, but also have the kind of like the Bakun dams and you're saying the Semelanjung.
There are only a few around. So if you're Occam's last quarterly investor briefing actually showed a map of I believe it was Occam. I might be wrong, but there are only, I would say, go as far to say probably about a handful of plants in the silicon metal plants in the world that are able to source the energy from new renewable energy.
Right. And do you remember roughly the other countries?
I believe some of them are in in North America, and some of them are in Scandinavia.
Perfect. So the cost is definitely higher.
Yeah.
Because what is interesting about the Bakun Dam when we were looking at Press Metal for another presentation was that not only are they renewable, but they are cheaper as well. Actually, the guys who run the Bakun Dam, I don't know how they make money, honestly. And John, maybe as a Sarawakian, you can share.
Actually, if, this one goes back to history. And actually, there's this podcast that MJ and I've talked about, but we haven't had the time to do it yet. It was actually with regards to Nazir Razak's book.
Right.
Yeah.
So the reason why Nazir Razak and CMB?
Yeah, I remember this part. Yeah, it
because
didn't make economic sense because Nazir Razak was against Tun Mahathir's wanting to build this up, right?
Bakun,
Something like
yeah. And also, it was Bakun, the Bakun Dam and Ekran was the reason why CMB only suffered loss
The one of that year, yep, correct.
that year.
Yep.
Yeah. Because they were trying to find, long to short, huge excess of capacity because Sarawak doesn't need that kind of energy.
Yeah.
And it was uneconomical to actually draw or to lay a cable all the way from Sarawak over to West Malaysia to supply the grid here. So they were at a loss, and PNB, Press Matter, probably right time, right place, offered to take up a lot of this energy, which I think they took taken up almost
dirt
all.
cheap lah.
It was
Dirt
dirt cheap,
cheap.
and a very low tariff. And I think it works. It's kind of like win-win lah. There's someone taking out the power. Yes, if you look at it as if the Sarawak government or Sarawak Energy specifically actually lost out in that deal. But then again, better someone taking out the power than
nothing
no one.
lah.
Nothing lah, you see.
Collecting dust.
Yeah. And there was quite a lot of environmental damage actually based on Bakun. But I guess what's done is done. You can't undo whatever Bakun did already. Yeah. But
So yeah, Sarawak is still a beautiful place, so not
Yeah.
too bad, you know.
yeah.
So yeah, I think that's a very interesting. You share your thoughts about valuation and how you think that it's on the top-ish side. And yeah, thank you for
At the
sharing.
moment.
At the moment, yeah.
Yeah, at the moment.
So now, thanks for sharing all these three companies. I think we're coming towards the end, but I only really have a couple of questions left for me. I think the first one is, when you look at, so we talked a lot about like the details, the bottoms up approach of looking at investing. So maybe let's go higher up, right? The 30,
Top down.
50%, 50,000 feet view on the portfolio level first, which is, how do you think about like managing your portfolio? Like, how many stocks do you have? And then when you look at a company, are you like, you know, I'm just going to put it all in, or are you going to like scale in? And then when you sell, do you sell everything or do you scale out? How do you manage when, you know, a stock is like too much of your portfolio, or in your estimation of too much of your portfolio? What is too much? Things like that. Maybe you can give us a sense of how you manage your portfolio.
Okay, the first one would be that my portfolios are generally considered focused portfolios. So they don't, in essence, contain stocks more than 10. More than 10 stocks.
Okay.
Yep.
Okay, and so I would say the benefit of that is that I'm able to keep track of the companies in a much more intimate way. You know, like I'm able to be more in touch with what's going on, and as well as that, because I think the thing about companies, there's a lot of things going on all the time.
Oh, yeah, exactly.
Right, and there's always this thing be like that. It makes it easier as well if I also want to find a better investment at the same time. So it helps a lot. So for example, we were talking about SuperComnet. So
Yes.
at one point I bought SuperComnet around the price was okay. It was one ringgit 20 cents to 1 ringgit 30 cents plus minus. And then at that time it touched very close to 2 ringgit. I think it was sometime last year.
Okay.
Mid second half or third quarter of last year. And at that time, SAM Engineering was trading at a price of between 13 to 15 ringgit.
Okay.
Right? And then there was when I assessed like, okay, SuperComnet looks overvalued. At this moment in time, let's say if the net profit was 40 million next year. And so I decided, okay, SAM Engineering looks by my estimation of SAM Engineering, that time was about conservatively at 25 ringgit. That was my estimation of so-called intrinsic value for SAM Engineering. And so at that price, SuperComnet just, you know, as a
Kinda
stock, right? Not as a company, but as a stock.
Don't fall in love with the stock.
Yeah. So that was when I decided to take away Escomnet from my portfolios and then to buy SAM Engineering. And then I remember I posted this article on StopBit titled "Sell Opinion ... SAM Engineering a Sell." So I posted that on StopBit. It was just before because so I held SAM Engineering until the time just maybe about a month or a bit ago when I felt that okay, I think at this price SAM Engineering is not being priced for its aerospace segment, but it's actually being priced for its contract manufacturing / equipment division.
Yeah.
Right. So the re-rating came not because of his aerospace division was it came from
the equipment.
from his equipment segment. So for me, applying Occam's razor again, I just looked at it purely as a contract manufacturer, its equipment division, right? And so it was trading at around 22 ringgit-ish, 22, 23. And then I felt that, okay, I think there's more downside at this point in time than upside. Of course, I was speaking more into terms of short-term than long-term, but this is how I manage my portfolio. Risk is a big part of it, and I felt that SAM engineering at that price presented a lot of risk. Of course, some of the people who are proponents of SAM engineering said that, okay, the price is very resilient because some of the major shareholders are Capital Dynamics and Public Mutual. So these are one of the most steadier hands in the market.
Diamond hands,
and rightly so. But of course, since then, the price has also dropped quite a bit.
You must be talking the prices
Pre-bonus issue, right? There was pre-bonus issue.
When was the bonus?
So the bonus was 1 for 1.
It was no, it was 4, 3 for 1, I think, or 4 for 1.
Okay.
It just.
So now it would be 10 lah.
So 16, I think. I believe is equivalent to 16. It's 4, is it?
If it's 1 for 3, so you times 3 the current price, so it's about 10, 11 lah.
3. Yep.
Okay.
Yep. Okay, so wow, I mean it's been a big drop since then, and so this is where I apply my form of risk management. And for me, for those actively managed portfolios, this is what I constantly do when it comes to portfolio managing. That I always look at the price and be like, okay, how much of the company's future profit has been baked in already? And if there's a very strong likelihood that because of the current climate right now that the stock may drop quite a lot, then and I'm able to find a better investment, then this is what I do. Then I move on.
I remember when I chat with you, you were saying that I think you got out at 18, right? Pre-bonus, you said.
SAM engineering.
Yeah.
No, it's above 20 ringgit, 21 or 22.
And then that's when you shifted to ANCOM, right?
Yes. That's when I shifted. That's when I thought, okay, I think ANCOM is in a space where its PE can grow. And it's got the growth catalyst as well for both of its segments. So I thought,
Nice.
So I thought, of course, I'm not trying to say that you should be timing these things. But I should say that, okay, from your mental model of risk management and valuation, that these sort of movements in your portfolio managing can be done.
It's a good point because both of us missed VTROX.
Right.
And the reason why we missed it was because we kept on saying, well, P is high, whatever. But the recent tech sell down was actually a good opportunity for not just VTROX, but a lot of companies.
Definitely.
So many here.
Yeah, it's like, I look at it,
everything is
like,
on sale.
I can't believe that some of these are selling for 20 times PE, 25 times PE, right? Which in the past, for you to get even at 30 PE would be a bargain, that kind of thing.
Yeah. So that's one of the debates right now in the investment community, right? Like investors are in a way willing to pay more for high growth companies. But on a 3-year sense or 5-year sense, how much? So it's not as easy as it seems to be able to discern, right? Because even from different tech companies, there are different parts of the value chain. They have their margins are different. Their business model is so different. And
I remember I was saying this to my Penang investor friends. It's like, can you imagine buying VTROX at a PE of 70, and they were making I think roughly 300 million revenue a year, versus that of TSMC, which is a global leader in foundry and all that, which is selling to you at a PE of 30 to 28 to 30 times PE, right? So for me, it doesn't make valuation sense, right? But now, truth be told, VTROX has not dropped to below let me see, what is VTROX? I think it's probably about 20-ish, 30-ish kind of valuation. So I guess again, not a buy or sell call. It's just that sometimes opportunity presents itself, and here we are trying to justify that it's it's still too high or whatever lah. So
yeah, man. By the way, I want to ask you as well. Oh, it's down
Wow,
again.
P at
Nice.
17.
Yeah, but this may be wrong because they did not take into
Okay.
account the bonus issue apparently.
Okay.
Yeah.
Okay.
Yeah, I wanted to ask you like, what are some of the disasters that you've experienced?
yeah.
If there's any.
Oh, this is an easy one. Air Asia.
Okay.
Okay, yeah, this is what was one of the things as well that really spurred me on to really look into investing at a deeper level.
Yeah.
Because at the time I was just like any other blind retail investor, right? Air Asia dividend yield 30+%.
Yeah.
You know, but I did feel that at that time when Air Asia sold all of their assets, so to this
the leasing
leasing company so that they could lease it back. I'm not sure if that made sense. I'm not sure. But at that time, I was like, you know what? Like the dividend yields was so high. You know, like I just.
But it was a once-off, remember?
Yeah, exactly,
Yeah.
right? So I think, and of course, COVID came.
Yes.
Right, and then the stock plummeted. The stock plummeted from well over 3 ringgit to 80 cents or something like that.
Yeah.
Right, and so I think those is I would consider one of my big disasters for Asia because like I think investors should not be mistaken into buying like sexy companies, right? Because Asia, I suppose at that time was considered like a very sexy company, right?
Yeah.
And everyone talked about Asia, right? And I think there's a certain seductiveness to airline companies, I think.
Yeah.
Right.
Because it's a front-facing brand.
Yeah.
You've got a very suave CEO.
Yeah.
So
Yeah.
I've lost money in Asia too. So
Yeah.
same
Yeah.
boat.
Capital A. Capital A. now.
Capital.
Yeah, now
yes.
it's called Capital A.
Yeah.
So, but so far, ever since then, I've managed to minimize my risk because I just decided the entry price is important and use time. Time is your friend and not your enemy. And
How do you? So my guess based on what you've just said, you probably have a watch list. And every time, is there a price alert or a tool that you use to alert yourself of what companies you have in your watch list? And
I actually don't use that.
Yeah, but I'm guessing that you have to look at the prices almost like every other week or once a day.
Yeah, something like that. So what I try to do is that I don't log into my brokerage account. I just have that app on Apple. Then it just tells you what the prices are every day.
I see. So that's where you get some sort of an alert mechanism.
Yeah.
Got it.
Yeah.
All right, man. So final question. This will be a more general one, which is I know you write letters to your investors as well. So and you talk a lot about what's happening like in global markets, like from a macro
point
right?
of view.
So I mean, I'll just throw a few words, right? Your interest rates, your inflations, your whatever, right? So what have you told your investors, and what will you tell some of our listeners regarding the global macro environment?
Okay, this is interesting because before the 2022 big correction happened in January, I was also everyone was talking about the interest rates that were going to come, right? And so I was also reading up on how the stock markets behaved during interest rate hikes back in 2000. I believe it was the last one was 2017, the interest rate hike cycle, and the one before that was 2014, I think.
Okay.
Right? And so in both times, the stock market, NASDAQ, S&P, Dow Jones, they all went up in accordance to the interest rate hike. So the correlation between stock prices and interest rates, of course, discount cash flow valuation tells you otherwise, that they are negatively correlated. Right? But actually, that's not the case because most of the time, interest rate hikes happens in such a way that it coincides with economic growth as well.
Yes.
So, but what's very different from these last two cycles is that they didn't have a very high inflation. Okay, so we are faced with a very different situation, similar but yet quite different as well. And so I do think that the premise that economic growth, a sustainable economic growth that offsets inflation, is still healthy for equities. But in this case, right, we have very increasing, even in the US right now, inflation is increasing. Now it's touching 8% already.
Yes,
7.9%.
Correct.
In Europe, depending UK or the rest of the EU, is between 5 to 6%. And in Malaysia, I think we're touching 3.5%.
Yes.
I think the last one is 3.3, right?
Yeah.
The inflation
I think
rate.
there was a peak in Malaysia. CPI was about 5, if I'm not
Right,
mistaken. Yeah,
right.
but it's on a slightly on a downtrend, right? Yeah, continue, please.
Okay. And so I tried so for the stocks that I wrote when I was writing my letter to my investors, I was saying, okay, this is how we can best manage it without predicting what will happen to the stock market, right? And so one of the things is that these companies will need to have some form of inflation hedge or pricing power, or they're able to at least pass on their material costs to their clients, right? And so about 80 to 90% of the companies that I had in the portfolios at that time actually had free cash flow. They had pricing power to some extent. They had inflation edge. They were able to pass on the material costs to their clients. And they had strong balance sheets to weather anything that will happen to them. And let's say if COVID lockdowns happen again, etc. Because, of course, retrospectively, hindsight 2020 is perfect, but at that point, that was the best way to hedge against what was happening. And at that time as well, I started assessing all the technology companies that I had in my portfolios. And so some companies forward PE still made sense, but some did not. And so one of them was DNO, right? At that time, DNO's forward PE, I estimated, was about 40 plus.
Yeah, 40
That's
plus.
forward PE. Okay?
That was at a point when it was about 7 something,
yeah,
right?
70 plus PE, right?
No, 7 ringgit something lah.
Yes. Oh, I'm not sure if it touched 7 ringgit, maybe 6 ringgit plus.
Let me see.
But I remember the DNO's PE was about 70 to 80.
Yeah, 70 to 80, yes.
And then I knew that in this point, right, I think for risk management's sake, even though the company is fantastic, the business is fantastic, I needed to start trimming DNO. Definitely. And and of course my timing was not so bad. DNO did drop quite a lot, but all the other tech stocks in my portfolios as well also dropped. Yeah. Right. And so that was one of the ways that I managed my portfolios at that time.
I see.
Right. So that was more on the portfolio management side. And then and that was the gist of it. Besides the explaining the stocks behind the stocks, that was literally what I wrote to my investors. Like, okay, the best way for us to hedge against this is that the companies are able to make free cash flow, which DNO did not have. Yeah. And they need to have a reasonable forward PE. Yeah. Okay, so that's one part. So to the other part of your question about my view on the macro environment, I do think that Jerome Powell's job is probably the worst job right now in the world. Yeah. Right? So no matter what you do, probably you get a lot of hate.
Damn if you don't lah.
And I actually think that there's not much things you can do apart from up or down.
Interesting enough, I'm of the view that, okay, so I think the thing about inflation is that inflation is made out of many different components, right? All these commodities, they all add up together to have, and then they say, oh, this is inflation. Yes. Right? So sometimes it's a matter of like, are you talking about crude oil? Are you talking about agricultural prices? Are you talking about nickel prices, palladium? What are you talking about, right? But overall, inflation is causing quite a lot of difficulties to the market. And so, but right now I am of the view that the inflation is high more because of supply chain disruption and not because of demand. Not so much on demand, I think. And so, but the thing is that if the Federal Reserve increases interest rates to a very high extent, then it chokes demand, right? But it's the supply part that's causing inflation.
Yes, exactly.
Right? So if you choke the demand, inflation, it might cause quite a lot of havoc to the market, and you might not actually solve inflation, right?
Actually, they're trying to wave a very big one to solve. They're trying to swat a fly. If I would put what you're trying to say, swat a fly using a very, very big stick lah. The problem is that the stick may not end up hitting the fly.
Imagine trying to swat a fly with a badminton racket.
Yeah.
Go quite fast.
So I feel like that's what might happen,
Yeah, exactly.
Because assuming that let's say the US economy is not really growing at the pace that the market expects, then you get stagflation, right? High inflation and not enough economic growth.
Correct.
To offset the inflation. But I would say that if the Federal Reserve does not pick the right decision, then I think that could really well happen actually.
Yeah.
Because you want to manage inflation but without choking too much growth.
Correct.
So you have this insane balancing act, right?
Yes.
And of course, I wouldn't want to be in Jerome Powell's shoes,
Yeah.
right? It's I think, but overall, I do think that this high inflation stage is here to stay. That's what I think. I wouldn't go as far to say that it's transitory. I think transitory means that it goes up and then go back down to the same level. I would say that it will go up and then it become more sustainable by a bit more higher levels, I think. Because in the end of the day, there needs to be the right growth and consumption for inflation. But at the same time, I really don't think that the Federal Reserve will be increasing the interest rates the way that the market thinks that they would be. That's just my view. 7 to 9 rate hikes, that's like 3 whole percentages, right?
Yeah, you want to destroy the people's pensions? Just do it, man.
And then even can you imagine like over the COVID pandemic, all the people that were buying houses?
Yeah.
You can imagine like the increase in the mortgage rates as well.
Oh yeah, yeah.
So because interest rates are not variable, they're variable.
Correct.
Interest rates, they're not. It's like not like a fixed interest rate they're paying for, right? In the mortgage,
It's not a sukuk. Or it's not a Islamic loan.
Yeah, exactly. But even Islamic loan is quite high, right? The interest rate.
It's about. I mean, during the times I remember, it was probably about 10%.
Yeah,
fixed
that's
rate
what I thought.
over 30 years.
Exactly. Yeah, that's what I heard as well.
Yeah.
So right? So there you go. Like, can the Federal Reserve actually afford to increase interest rates so high and then shock the market? I think they can't.
Yeah.
I really think they can't. I think the best at the moment is probably 25, 50 basis points. And please leave the market alone.
Yeah.
Right?
Let it sort itself out. Put it this way.
Yeah. So I think inflation is very interesting. Maybe there's an interesting story I also want to share about inflation. I think not many people would know about this. But I was sharing to MJ before this. So last Christmas, I went to go... I went to visit the Louis Vuitton shop.
Okay.
Right? So I went there with my girlfriend at that time.
Yeah.
And then when I went there, I was looking at some of the stuff, some of the shoes, and of course the handbags. And then the worker at the time was like, if you don't buy by the end of February or March, we'll hike it up another 4 to 6%, something like that. Yeah. So I was like, why? I was like, oh, this is what we do, right? And we increase the prices of our products 3 to 4 times a year.
Yes.
Right? And then every time it's like 5% plus minus.
Yes.
So can you imagine like we're talking about inflation, right? And there's a hedge for inflation.
Yeah.
Right? Even Louis Vuitton products these days are like the perfect hedge for inflation, if not even better as well. So I thought that was very interesting because, there's a thing about Louis Vuitton products, right? It's like they say that diamonds are a girl's best friend, but handbags are just a girl's lifetime partner.
Yeah.
I think I literally just saw this worker count, and this couple they were buying something. I don't know what they were buying, but
in cash, is it?
They bought in cash. So this worker counting wads of cash. And then
probably they just put a machine in.
Yeah, they were just like, they were there. He was there for like half an hour. And both of them were just counter checking each other, you know. And this is not like a buy call, but then I was like, wow, this is like the power of branding, your brand, right? And even your brand in relation to inflation, right? And I thought, wow, this is also could be a company to look
actually,
at as well.
we had one of our SIB clients, also considered a friend now. He's been on a podcast before, so he's actually an investor in LVMH.
Right.
And if you think about it in terms of economics, it's a category of product that the more expensive it is, the more people want to buy it. Because it's a very different way of thinking about businesses where we think that most businesses scale, economics of scale, bring down prices and all that. Yeah. That is for survivability. So you talk about food and all that. But in this segment, and I link this to another pet peeve I have on cars, is that, so there was this, he was vice president for Bugatti sales.
Right, okay.
He said when someone buys a Bugatti, it's not to get from A to B, you know.
Yeah.
It's a product of emotion. It's a product of pride, a product of ego, right? So
definitely.
So when you just imagine, so the joke I have, I mean, encapsulating all this, the joke I have is, You don't walk into a Louis Vuitton shop and ask, what's the discount of the month?
Yeah, definitely.
Right. It doesn't work that way.
It's the opposite. What's the price
What's
hike
the most
now?
what's the price hike, or what's the most expensive? What's the most limited edition? Right. So I think why is this important and pertinent to investors? It's not that I know some of us may not be able to afford it or whatsoever, but if you think of it from a point of an investor, you look and understand the rules of the game. Because the rules of the game, when you invest in something like a D&O and a VTROX, is really a price game, value for money, whatever. Whereas when you choose to play and invest in the rules of the game of that business, it's really about exclusivity, it's about that. Right? So it's a very different rule. And I think that's the beauty of our investor. When you build mental models that suit businesses and understand these businesses well and understand demand. Because you're here to solve a problem. And what is the problem that Louis Vuitton is solving is actually a problem of, ironically, ego. Right? Ironically, a status symbol, whatsoever. So status symbol is not about being cheaper, it's not about value.
Exactly.
Yeah. I mean, you remind me of something the CEO of Ferrari said, which was that we always sell one less car than demand.
Yeah.
They always sell one less car than demand. So it's quite cool.
And it's interesting that even during the COVID pandemic, Louis Vuitton was doing so well.
Exactly. Yeah.
Wow.
We know friends that were trading bags.
Yeah, we know friends that were trading bags, and the
So it's become an asset, right?
second-hand bag market actually blossomed because people could not travel.
You see? Interesting.
Yeah. So
You wanna tell us what you told your then girlfriend after you can't.
Oh sure. So at that time we were lining up, right? So we had time because in Louis Vuitton they only you can only have a certain amount of people there.
yeah, exactly.
Right? And so I just looked up what Louis LVMH share price did. So over 5 years it did quite close to 300%.
Okay.
And then
you told
my
girlfriend.
girlfriend at the time, was like, can you imagine the amount of money you spend on your bags? Imagine you just put it there and you invest in Louis Vuitton. Imagine how many more bags
Yeah, you
have
could have
bought
gotten,
now.
right?
And that's why now it's still friends.
So and then she was like, this is the difference between you and me.
Yeah.
So that's like a relationship tip, right? Like if your values with money don't match, then
Yeah, spot on, man.
Yeah.
Spot on. Yeah.
I think that's super important as well.
Yeah. I completely get you, and I completely agree, because my first trip to the US, I actually bought a lot of Coach bags for my wife because it was really cheap.
Right.
And it ends up in storage right now because my wife rather carry a
Vertical.
A what?
Recycle bag.
Oh, right, fair enough. Or a tote bag.
Yeah. So
That's so true. But that was I need to ask that because that was the perfect ending to this podcast. Thank you so much for being on. Thank you for allowing us to be your first host in the podcast. And,
hope you enjoyed the session, man.
No, definitely. It went much better than I expected.
Okay. 3 to 4 months time, we'll ask you 3 different stocks. That's
sure. Yeah. I'll be very honored to come back on again.
Yeah, this is one of the most interesting and unique podcasts. Started with the Bible.
Yeah.
And then ended with some relationship advice.
Yeah.
So like if you want to find you, where can they find you actually? Because I know you run a Telegram group chat as well,
yes.
right?
I have a Telegram channel where I share some of my analysis, some of my thoughts, as well as news. So if you're looking for me, you can find me. You can find me as EQUISEARCH Capital. So it's spelled as EQUISEARCH.
I think we'll leave a link in the comment section.
Okay.
Pass it to us. Yeah.
And then if you want, you can also follow me on Instagram, which is Leon Jake Lim.
Okay.
Yep.
And you're quite
Guys, it's
active
not
on
Leon, guys. It's Leon.
Leon. And you're quite active on StockBit as well, right?
Yes. So on StopBit, I'm also known as Leon
I have to
Jake
give
Lim.
our good friend Rondi a shout out. He keeps on saying, "Hey, please promote StockBit." Yeah, of course.
Yeah. And I think StopBit is a fantastic place for even people who are beginner investors to even learn. Yeah.
I think people are willing to teach there, right?
Yeah, exactly. It's not like the other So I think the StopBit community is a very healthy place, and people are always really very willing to share.
Yeah.
And for me, like even when I started researching stocks, that's how I got connected with David Poe. David Poe from Spiral Thinker, common friend.
Yeah.
And he is also very happy to share, and I'm very thankful to David Poe as well, because he was the ones that actually gave me some a guiding hand on how to look at KESM actually.
I see. Yeah.
So I give some credit to him as well.
Yeah. Great.
Yeah.
All right, man. Guys listening, 100%. I think this is a pretty long podcast, man. I think it's 2.5, 2 hours, 15.
Yeah, 2.5
Wow.
already.
Yeah, I didn't realize. So if it's good, you know, it
I hope
flies,
so,
man.
I hope
it
so.
flies.
Yeah.
For sure it's good. And yeah, guys, if you like this kind of content, remember, you know, follow us on Instagram, subscribe, notification bell so you know when new fresh videos. And of course, if you enjoyed the podcast and you know someone who might enjoy it, please share it with them. And of course, we're on Spotify as well. And guys, signing off. See you in the next one.
Thank you.